on which the county governments will share the 35% of the 9 trillion, and that has to be done through the county allocation of revenue bill. You understand? The total amount allocated to county governments in the division of revenue bill forms the basis for the subsequent allocation of funds to individual counties through the county allocation of revenue bill. Through the county allocation of revenue bill. And that now will be our next thing to consider, the county allocation of revenue bill. County allocation of revenue county allocation of revenue bill. County allocation of revenue bill is the second crucial piece of legislation in the revenue allocation process. And its purpose, the purpose of the county allocation of revenue bill is to divide the total revenue allocated to the county level of government as determined by the division of revenue bill among the individual 47 counties. You understand? So, process of division begins with the division of revenue bill. The total amount raised nationally, it is through this bill that determines the percentage that will be taken to the county governments. Then, once that is done, there has to be another bill which now helps the division of that total amount amongst the among the other the 47 counties. You understand? It is the second piece of legislation in the revenue allocation process. And I've stated the purpose. The purpose is to do what? To divide the total revenue allocated to the county level of government among the individual 47 county governments. So what are the aspects of this bill? Just like the division of revenue bill, this bill has a constitutional basis. Constitutional. The bill has a constitutional basis. It is guided by Article 217 of the Constitution. 216 of the Constitution. This is 216 of the Constitution. 216 of Article 216 of the Constitution. This one is Article 203. Article 203. It has a constitutional basis. It is guided by Article 217 of the Constitution. It is guided by Article 217, not 16 but 17 of the Constitution. It is guided. This one is Article 203. Then the county allocation of revenue bill is Article 217 of the Constitution, which mandates the Senate by resolution to determine the basis for allocating the county government's share of national revenue among the counties. This bill is enacted at the Senate. It's enacted at the Senate. You understand? It is guided, first of all, by Article 217 of the Constitution, which mandates the Senate by resolution to determine the basis for allocating the county government's share of national revenue among the counties. And this basis is determined by it is going by the history of this country, it is determined once every 5 years. Okay, it is determined once after every 5 years, but the county allocation of revenue bill is enacted annually to apply the determined formula to the revenue share for the specific financial year. Do you understand? So the bill is determined by resolution. By resolution, the Senate determines the basis for allocating the county government's share of national revenue among the counties. And the basis is determined once every 5 years. We are talking about the basis, and not the bill, but the basis of sharing the national, the shareable revenue. Shareable revenue is done after every 5 years. But the county allocation of revenue bill is enacted annually, done after 5 years, but the bill is enacted annually to apply the determined formula. So the formula can change after 5 years, the basis. So do you understand? So that's the first key aspect. Then there is role of Senate, number 2. Role of Senate. Here we had the role of Parliament. We saw that both the National Assembly and the Senate, they are involved in the process of enacting the division of revenue bill. But for the county allocation of revenue bill, we have the Senate, which plays a primary role in the enactment of this bill, as it is responsible for protecting the interests of counties and ensuring the equitable distribution of resources among them based on the approved revenue sharing formula. You understand? It is enacted by Senate because it is Senate that has the responsibility to protect the interests of the counties and to ensure the equitable distribution of resources among them. 3. Another aspect is in applying the formula. Applying the what? Applying the formula. Now the bill translates the revenue sharing formula approved by Senate into specific financial allocations for each of the 47 counties. And the formula typically takes into account various parameters such as population, poverty levels, land area, fiscal responsibility, and so on. Application of the formula. 4 is facilitating transfers. Facilitating transfers. Facilitating transfers. An act that results from this bill, this is a bill. After the bill is passed, it becomes an act of Parliament. So the act, subsequent act, the act of Parliament that results from the bill authorizes the transfer of the allocated funds from the consolidated fund to the respective county revenue funds. So after the bill becomes an act, after it's signed into an act of Parliament, then it is on the basis of this enacted bill, which is now an act, that money can be transferred from the consolidated fund to the county revenue funds, the respective county revenue funds. Because once the formula is in place, it is known how much will be taken to county 001, 002, 003. It is known that the amount of that is allocated to each county. Then after the enactment of the bill, then money can now be transferred from the consolidated fund to the respective county revenue funds. Okay? That is Very important aspect. The act that results from the bill authorizes the transfer of allocated funds from the consolidated fund to the respective county revenue funds. Number 5, we are discussing the aspect of the county allocation of revenue bill. The 5th aspect is accountability. 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 From the word account. The bill often includes provisions related to the responsibilities of both national and county governments concerning the transfer and use of these allocated funds, which promotes accountability and transparency at the county level. So these are 5 key aspects of the division and 5 key aspects of the county allocation of revenue bill. And it's important as we close to remember that the division of revenue bill and the county allocation of revenue bill are indispensable instruments in Kenya's system of devolved governance finance. Devolved government finance. They are indispensable. Because the division of revenue bill determines the vertical allocation, the vertical share. The division of revenue does what? Determines the vertical share. It determines the vertical division of nationally raised revenue between the 2 levels of government, while the county allocation of revenue bill ensures the equitable horizontal sharing. Equitable horizontal sharing. After this money is shared to the county government, it is now this bill that helps in the horizontal, because counties are on the same level. It's horizontal. That is vertical. Okay, the first one ensures the vertical sharing. This one is now horizontal. These counties, through the county allocation of revenue bill, then these counties can share what was determined by the division of revenue bill. And that enables them to fulfill their constitutional mandates and deliver services to their populations. And that's all, candidates, as far as the division of revenue bill and county allocation of revenue bill is concerned. We did set at the beginning that in Kenya's devolved system of government, the equitable distribution of financial resources between the national government and the county, 47 county governments, is a crucial aspect of public finance management. And the process is primarily governed by 2 legislative instruments, that is the division of revenue bill and the county allocation of revenue bill. You understand? We stated that the division of revenue bill and the county allocation of revenue bill are key instruments. These are annual bills that are mandated by Article 218 of the Constitution. These are bills that are central to the operationalization of the decentralization, and also ensures that both levels of government have the necessary funds to perform their functions. So that is all for today's lesson. Bye. Greetings, candidates, and welcome to the lesson. The subject is public finance and taxation. Today we are going to study the second subtopic of topic number 1, sources of public finance. The topic number 1 is introduction to public financial management. In today's lesson, we're going to highlight the various sources of public finance, and candidates, governments at all levels require financial resources to provide public goods and services, to manage the economy, and implement their policies. The government requires financial resources, and these resources are collectively known as public finance. Collectively known as public finance, they are derived from a variety of sources. And the primary sources of public finance can be categorized into two major categories. That is the tax revenue and non-tax revenue. So there are two main categories of public finance. One, tax revenue. Tax revenue. Number one, tax revenue. The second category is non-tax revenue. Non-tax revenue. The first category, tax revenue. Now, this is the most significant source of government income in most countries. Tax revenue. And taxes are compulsory payments levied by the government on individuals and businesses, including entities. So taxes are compulsory payments levied by the government. And they can be broadly classified into direct taxes. Okay, we may also have indirect taxes. So direct taxes can either be direct taxes are imposed on the income and wealth of individuals and corporations. Direct taxes are imposed on income of individuals and businesses. Direct taxes. We may have, for example, the income tax. Income tax. Now, income tax is imposed on the income and wealth of individuals. So direct taxes are imposed on the income and wealth of individuals and corporations. So we may have income tax, which is a tax on the earnings of individuals and households. Income tax is the earning of individuals and households. Income tax. Then you have corporation tax. Corporation tax, on the other hand, is a tax on the profits of companies. Corporation tax is a tax on profits of companies. So income tax is levied on individuals and households. Corporation tax is levied on companies, corporate entities. 3, we have what we call wealth tax. Wealth tax. This is a tax on the net worth of individuals or households, which is less common in many countries. This one is less common, but it's a form of a direct tax. 4, property tax. Property tax is a tax on the value of real estate and other property. Tax on real estate and other property. So these are examples of direct taxes. We say that taxes can either be direct or, number 2, indirect. Taxes can be direct or indirect. Now, indirect taxes are levied on the goods and services. They are levied on goods and services and are typically collected by producers or sellers who then remit the taxes to the government. So the burden of these taxes is often passed on to the final consumers through higher prices. For example, we have value-added tax is an indirect tax. Value-added tax on goods and services. This is a tax on the value added at each stage of production and distribution. Value added tax. Another example of indirect tax is sales tax. Sales tax is a tax on the sale of goods and services at the point of sale. At the point of sale. Excise tax, excise duty. Excise duty is a tax on the production or sale of specific goods like alcohol, tobacco, fuel, and so on. So excise tax is a tax on specific goods. It could be alcohol, it could be tobacco, fuel, and so on. Customs duty or customs tax. Customs duty, on the other hand, is a tax levied on imported and exported goods. The tax levied on imported or exported goods. So these are examples of indirect taxes. So Candace first of all said that government resources are known as public finance. We've said that governments at all levels require financial resources. Like in Kenya, we have the national level government, we have the county level government. All these governments require resources to manage the economy and implement their policies and provide goods and services, public goods, and so on. And all these resources are collectively known as public finance, which we've said can broadly be categorized into two: tax revenue and tax revenue. Tax revenue constitute direct taxes and indirect taxes. First of all, we said that tax revenue is the most significant source of government revenue or income in most countries. And these taxes are compulsory payments. Taxes are compulsory payments levied by the government on individuals and entities. They are broadly classified into two: direct taxes and indirect taxes. So we've analyzed the tax revenue, which could either be direct taxes or indirect taxes. Examples of direct taxes are income tax, corporation tax, wealth tax, property tax. Indirect taxes include value-added tax, sales tax, excise tax, and customs duty. So let's move to the second category of sources of public revenue, which is non-tax revenue. Number two, non-tax revenue. Number two, non-tax revenue. Non-tax revenue. Non-tax revenue. This category includes income generated by governments from sources other than taxes. This is a source of government revenue other than the tax sources. And this include fees and licenses. One, fees and licenses. Fees and licenses. These are charges for specific services provided by the government. For example, we have the passport fees, driving license fees, business registration fees, and so on. Two, fines. Fines and penalties. Fines and penalties. Fines and penalties. These are payments imposed for violating laws and regulations. When individuals violate the law, they may be fined, they may be penalized, and these penalties and fines is a form of non-tax revenue. Three, we have profits from public enterprises. Profits from public enterprises. Profits from public enterprises. This is income generated by government-owned businesses and corporations. 4, rent and royalties. Rents and royalties. Rent and royalties constitute income from the lease of government land or even the extraction of natural resources. 5. Grants. Grants. Grants are financial assistance received from other governments, and this could be domestic or foreign or international organizations. And this can be conditional, which are tied to specific uses, or grants could also be unconditional. 6, we have sale of goods and services. Sale of goods and services is also another form of non-tax revenue. Sale of goods and services. This is revenue from the sale of goods and services produced by government departments or entities. Next, interest receipts. Interest receipts constitute income earned by the government on its loans or investments. Income earned by the government on its loans or investments is what is referred to as interest receipts. Interest receipts. So this is the second category of sources of government revenue, sources of public finance. 1, tax revenue. Number 2, non-tax revenue. The third source is known as public debt. Public debt. Public debt. Public debt. Public debt. Now, when government revenue is insufficient to cover its expenditures, it resorts to borrowing. So public debt represents the total outstanding borrowing of the government, all right? The total outstanding debt or borrowings of the government is what we refer to as public debt. Public debt. When government revenue is not enough to cover its expenditures, the government may resort to borrowing from various sources. And what is borrowed constitutes what we call public debt. Public debt. And it could be either through issuance of government securities. 1, issuance of government securities. Issuance of government securities. This is selling of bonds, treasury bills, and other debt instruments to individuals, to banks, and other institutions, both domestically or internationally. So the government may issue securities like treasury bills, like bonds, and so on. So it issues these securities in exchange for money. So banks, individuals, and other governments may give the government money in exchange of these securities. So that constitutes what we are calling a public debt, the issuance of government securities. Then we have loans from domestic sources. Loans from domestic sources. Loans from domestic sources. This is borrowing from commercial banks and other financial institutions and the central bank within the country. The government may resort to internal borrowing, domestic borrowing, borrowing from internal sources. That's what constitutes loans from domestic sources. Then we have external borrowing. External borrowing. External borrowing means obtaining loans from foreign governments, from international financial institutions like IMF, like World Bank, and foreign commercial banks. And foreign commercial banks. So these are sources of public debt. government securities, loans from domestic sources, and foreign debt or external borrowing. So this is the third source of public revenue. The first source we saw is tax revenue. Number 2, non-tax revenue. Number 3, public debt. Number 4 is money creation. Money creation. Money creation is the third source of government revenue. In some instances, governments may finance the expenditure by printing more money. And this is often considered a form of what we call implicit tax, or what we call inflation tax, because it can lead to a decrease in the purchasing power of existing money. However, this kind of activity is generally used very sparingly due to its potential to cause inflation and economic instability. So the government sometimes may create money, print money, and that can be very dangerous to the economy. That can erode the purchasing power of existing money. That's why it is not used more often. 5, sale of state assets. Sale of state assets. This is another source of public revenue, or what we call privatization. Privatization. Governments can create or generate revenue by selling their own ownership in public enterprises or other assets to the public sector. And this is often a one-time source of revenue. So these are 5 major sources of public finance. The first source is tax revenue. We've said tax revenue is the most significant source of government revenue, and it could either be direct taxes or indirect taxes. Direct taxes include income tax. Number 2, corporation tax. Number 3, wealth tax. Number 4, property tax. Then you have indirect taxes, the value-added tax, the sales tax, the excise duty, and customs duty. Source number 3, non-tax revenue. 1, fees and licenses. Fees and licenses. These are charges for specific services provided by the government, like the driving license fees, the business registration fees, and so on. Number 2, fines and penalties. 3, profits from public enterprises. 4, rent and royalties. 5, grants. 6, sale of goods and services. Then we have interest receipts. This is income earned by the government on its loans or investments. Then number 3 is public debt, which could be either through issuance of government securities like treasury bills. Number 2, we have loans from domestic sources like commercial banks. Number 4, we have external borrowing. The government can borrow from external sources, from foreign governments, international financial institutions, and foreign commercial banks. The 4th source is money creation. In some instances, government may finance expenditure by printing more money, which we've said is considered a form of implicit tax or inflation tax. Then lastly, we have sale of state assets or privatization. Governments can generate revenue by selling their ownership in public enterprises or other assets to the private sector. The government can privatize state corporations, or can sell off their interest in these companies. So these are 5 major sources of public finance. Now, the specific mix and reliance of these sources of public finance vary across countries depending on the economic structure, depending on the level of development, depending on political priorities and fiscal policies. You understand? One country may rely on tax revenue, say 70% or 90% of its total public finance may be from tax revenue. Then the other 10% is distributed across these other sources. So the specific mix and reliance on these sources of public finance vary across countries depending on their level of growth of economy, depending on their fiscal policies, political priorities, and so on. So can all for today's lesson on sources of public finance. Bye-bye. Hello, candidates, and welcome to the lesson. The subject is Advanced Public Financial Management. We are on the topic Management of Revenues in the County Governments. In today's lesson, we are going to study the role of the Commission on Revenue Allocation in management of county government revenues. The role of the Commission on Revenue Collection in management of county government revenues. So the Commission on Revenue Allocation plays an important role in the financial architecture of Kenya's devolved government system, extending beyond its primary function of recommending the equitable sharing of national revenue. So the primary function of the Commission on Revenue Allocation is recommending the equitable sharing of national revenue. So the Commission is also mandated to make recommendations concerning the financing of and the financial management by county governments, significantly influencing how counties manage their own revenues. So the Commission established under Article 216 of the Constitution, the CRA, the Commission on Revenue Allocation, abbreviated as CRA, has functions related to county government revenues. And that's what we want to study in our today's lesson. We want to highlight some of the functions that are performed by the Commission on Revenue Allocation in the management of county government revenues. But that is not its primary function. The primary function of the Commission on Revenue Allocation is making recommendations concerning the financing, on recommendations on the equitable sharing of national revenue. That's the primary function. So in this lesson, we are going to categorize the role of the Commission in regard to the county government in three ways. We are going to have three categories. The first one being definition or defining and enhancing county revenue sources. So the first, call it one. The first role is defining and enhancing county revenue sources. County revenue sources. Defining and enhancing county revenue sources. Defining and enhancing county revenue sources. County revenue sources. Now, the CRA is constitutionally mandated to define and enhance the revenue sources of both the national and county governments. So the CRA is constitutionally empowered to define and enhance the revenue sources of both the national and county governments. And in the context of county governments, that involves identifying potential revenue streams, identifying potential revenue streams, That is the first aspect of defining and enhancing county revenue sources, identifying potential revenue streams. The CRA conducts research. It also conducts studies to identify potential source revenue streams that counties can tap into, such as property rates, such as business permits, parking fees, market charges, and so on. The second aspect of the first point is recommending strategies for revenue enhancement. Recommending strategies for revenue enhancement. Now, based on its findings, and which findings are we talking about here? Based on the findings and research, the Commission on Revenue Allocation provides recommendations to county governments on how to improve their revenue collection efforts, and that may include advising on the implementation of efficient collection systems, leveraging technology for revenue administration, and also strengthening enforcement mechanisms. The third point is developing guidelines and policies. Developing guidelines and policies. The CRA develops guidance and also model policies to assist counties in effectively managing their revenue collection processes, including guidelines for revenue mapping, setting realistic targets, and also developing appropriate tariffs and pricing policies for services. So these are 3 points to illustrate how the CRA defines and enhances county revenue sources. So these are 3 points in relation to county revenue sources. Moving on to the second role is encouraging fiscal responsibility. Encouraging fiscal responsibility. The CRA is tasked with encouraging fiscal responsibility by both levels of government, and for the county governments, this translates to promoting prudent financial management practices in relation to their revenues. So the Commission monitors the financial performance of counties and also provides recommendations to improve accountability and efficiency in the use of public resources. Encouraging fiscal responsibility. That's the second role. The third role of the Commission on Revenue Allocation and Management of County Government Revenues is making recommendations on financial management. Making recommendations on financial management. Making recommendations on financial management. Now, beyond revenue enhancement, the CRA can also make recommendations on broader matters concerning the financial management of county governments. And this may include budgeting and budget implementation. Budgeting and budget implementation. Budgeting and budgeting implementation. This is to mean providing recommendations on county budget preparation, execution, and reporting to ensure alignment with fiscal responsibility principles. Number 2, B, is the second point in relation to making recommendations, apart from budgeting and budget implementation, is management of recurrent expenditure. Management of recurrent expenditure. That is to mean offering guidance on controlling recurrent spending to free up resources for development priorities. So the CRA also makes recommendations on management of recurrent expenditure. 3, debt management. Debt management. Now, while counties currently do not incur public debt in the same way the national government does, the CRA's mandate can extend to advising on management of financial obligations and pending bills at the county level. Debt management. Then the fourth point is adherence to PFM legislation. PFM, Public Finance Management Legislation. Adherence to Public Finance Management Legislation. Now, this means that the CRA encourages counties to comply with Public Finance Management Act of 2012 and other relevant laws relating to public finances. So these are the roles played by the Commission on Revenue Allocation in management of county government revenues. Do you understand? So we have categorized the roles into 3. The first one is defining and enhancing revenue sources. This role is in relation to revenue sources, and that is done through identifying potential revenue sources or streams. The CRA, we've said, the CRA plays a key role in helping counties identify various revenue sources. The CRA conducts research, it conducts studies to identify potential on-source revenue streams that counties can tap into, such as property rates, parking fees, market charges, business permits, and so on. Okay, recommending also strategies for revenue enhancement. Now, based on its findings, the Commission provides recommendations to county governments on how to improve their revenue allocation efforts, the revenue collection efforts, and that includes advising on the implementation of efficient collection systems, leveraging technology for revenue administration, and strengthening enforcement mechanisms. Then the third one is encouraging fiscal responsibility. Role number 3 is making recommendations on financial management. Making recommendations on financial management through budgeting and budget implementation. It also makes recommendations on management of recurrent expenditure, debt management, and adherence to public finance management legislation. So that is all, candidates. But we also know that the CRA may also have some challenges. Despite the CRA's mandate and efforts, county governments have faced significant challenges in maximizing their own source revenue potential. And these challenges often include inefficient collection systems. It may include a narrow tax base, weak enforcement, and even inadequate technical capacity. And in response, the CRA has been actively involved in research and data analysis. It has been involved in capacity building. It has been involved in advocacy for policy and legal reforms, and so on. So the Commission on Revenue Allocation plays a key role in the management of county government revenues in Kenya. And through its constitutional mandate to define revenue sources, to also encourage fiscal responsibility, and making recommendations on the financial management, the CRA is a key institution in supporting county governments to enhance their own financial autonomy in the management of county resources, and also to improve the service delivery to their citizens, to their residents, and so on. So that is all for today's lesson, in which we've studied the role of the Commission on Revenue Allocation in management of county government revenues. Bye-bye. Hello and welcome to the lesson. We continue with the topic customs tax and customs and excise taxes. Customs, taxes, and excise taxes is the topic. Today our focus is on bonded warehouses and bond securities. Bonded warehouses and bond securities. Now, candidates, in Kenya's customs framework, there is what we call bonded warehouses and bond securities. So in the Kenya's customs system, bonded warehouses and bond securities are integral mechanisms that facilitate trade by allowing for the temporary storage of imported goods before the payment of duties and taxes is made by the importers. So this temporary storage provides businesses with flexibility in managing their cash flows and also logistics. So in Kenya's customs systems, there is bonded warehouses and bond securities. Bonded warehouses. So let's begin with bonded warehouses. What are these bonded warehouses? A warehouse is a store. We know a warehouse is a store. So a bond warehouse is a secure facility that is licensed by the Kenya Revenue Authority. Okay, first of all, it is a secure, licensed secure facility licensed by the Kenya Revenue Authority under the East Africa Community Customs Management Act. It is a facility licensed by Kenya Revenue Authority under the East Africa Community Customs Management Act. Okay? And this secure facility is for storage of goods, for storage of imported goods. It is a secure facility licensed by Kenya Revenue Authority under the East Africa Community Customs Management Act for storage of imported goods on which customs duties and taxes have not yet been paid. On which custom taxes have not yet been paid. A bonded warehouse is a secure facility licensed by the Kenya Revenue Authority under the East Africa Community Customs Management Act for storage of imported goods on which customs taxes have not yet been paid. And these warehouses operate under strict customs control and supervision. So the primary purpose of using a bonded warehouse is to defer the payment of import duties. It is to postpone the payment of import duties and taxes until the goods are withdrawn from the warehouse for home consumption, for re-exportation, or other approved customs procedures. And that offers significant benefits to importers. It offers significant benefits to importers. This temporary storage of imported goods offers significant benefits to importers, which include improved cash flow. Please to improved cash flow. Now, businesses can delay the payment of substantial amounts of duties and taxes, which frees up capital for other operational needs. So if you have imported goods, you are a car dealer or importer, you have imported goods and you are required to pay significant customs taxes to the government, you will be benefited. You will benefit greatly if the goods are stored in this secure licensed facility, which you are calling bonded warehouse. So your goods will be retained in that facility until you clear the customs duties and taxes. So it provides what we call improved cash flow. So the money that you would have used to clear at the customs, that money you can use it to pay your salaries, to operational costs and other working capital needs. 2. Inventory management. Inventory management. Bonded warehouses allow importers to store goods closer to the market, which enables what we call just-in-time delivery and better management of stock levels. 3. Flexibility in re-exportation. Offers flexibility in re-exportation. Goods can be stored in a bonded warehouse and subsequently re-exported without the payment of import duties, which is beneficial for transit trade or repackaging operations. So that is the third benefit. Now the fourth benefit is consolidation and value addition. How is consolidation and value addition a benefit? Now, within a bonded warehouse, certain operations like repackaging, like sorting, and also labeling may be permitted under customs supervision. Okay? Although manufacturing is typically done under the separate, what we call manufacture under bond scheme. So that is it, candidates, for bonded warehouse. It's just a simple concept. A bonded warehouse is a secure facility licensed by the Kenya Revenue Authority, where imports are temporarily stored until the customs taxes and duties have been paid by the importer. So while a wide range of imported goods can be stored in a bonded warehouse, certain items may be restricted or even prohibited based on their nature, sensitivity, or potential for abuse. So the KRA maintains a list of goods that are eligible for warehousing in a general bonded facility, such as certain foodstuffs, building materials, and finished consumer goods. Although specific bonded warehouse for specialized goods like pharmaceuticals also do exist. Do you understand? Yes. So that is a bonded warehouse. Let's move to bond securities. Bond securities. Bond securities. Bond securities. Bond securities. Now, a customs bond security, often simply referred to as a customs bond, also referred to as customs bond, is a written undertaking or guarantee required by the KRA to ensure that an importer or other party will fulfill their financial obligations and comply with customs laws and regulations. And in the context of bonded warehouses, a customs bond is mandatory to cover the potential customs duties and taxes on the goods being stored. So the bond essentially acts as a form of insurance for KRA, guaranteeing that the revenue will be collected even if the importer defaults on their obligations. You understand? So once goods are stored in a bonded warehouse, there may be need to have a bond security, or what we are calling a customs bond. A customs bond. So a customs bond, we are saying, is mandatory to cover the potential customs obligations. Okay. So in the context of bonded warehouses, a customs, I'm repeating, bond is mandatory to cover the potential customs duties and taxes on the goods being stored. So if goods are being stored in a bonded warehouse, there may be need to have a bond security, which acts as a form of insurance for the KRA. It acts as a form of insurance for KRA. Remember, KRA, through the bonded warehouses, holds goods for importers. So KRA must have the guarantee that the taxes and the customs that are due on these imports are paid. So they may need to have that insurance for guaranteeing that the revenue will be collected even if the importer defaults. There are times when goods are stored here, the importer may default on payment of the taxes. So there has to be a bond security which assures KRA that that money will be paid even if the importer defaults on their obligations. And the parties typically involved in a customs bond are: one, let's identify the parties. The first party is the principal. The first party in a bond security is the principal. Now, the importer or the licensed bonded warehouse will now be the principal. The importer, I'm repeating, or the licensed bonded warehouse keeper, who is primarily responsible for the customs obligations, is the principal. Then the second party is the guarantor or the surety, or the guarantor. The surety or guarantor is a second party, and this may be an insurance company or a bank that issues the bond and guarantees to pay KRA the specified amount if the principal fails to meet their obligations. So if you are importing cars and the cars, you have no money to pay on arrival of the cars in the country, the cars may be stored in a bonded warehouse. So you may move to the bank or insurance company to guarantee, to give you the guarantee, to give the guarantee, to give the document, to provide a document to KRA indicating that in case this importer fails to pay the obligations, then the bank or the insurance company can do so. So an insurance company or bank could be the guarantor, and it is this bank or insurance company that issue the bond and guarantees to pay the KRA the specified amount if the principal, if this importer fails to honor their obligation. Then 3, we have the beneficiary. Who is the beneficiary? Now the beneficiary is the KRA, which is the recipient of the guarantee. KRA is the beneficiary because it is the recipient of the guarantee. So do you understand, candidates? So it is as simple as that, bond security. And there are various types of customs bond, which are identified by the specific forms like the CB6 form, which is for general warehousing bonds that exist in Kenya, each designed to cover different customs procedures and potential risks. And these bonds are contractual agreements where the guarantor pledges a specified sum of money, which is the bond penalty to KRA if the conditions of the bond, such as the eventual payment of the duties on warehouse goods or the re-exportation within the allowed time frame, are not met by the principal. So that is to say, candidates, that bonded warehouses provide physical space for the temporary storage of dutiable goods, while bond securities provide the financial guarantee to KRA that the deferred duties and taxes on the goods that are secured in these facilities will be paid. So the two, you can see, they work in tandem. If the goods are stored in a bonded warehouse, then KRA may need a guarantor, may need a surety that the obligations of the principal are met. So they work in tandem. They work in tandem to facilitate legitimate trade while facilitating legitimate trade and also safeguarding the government revenue. So you see, at times when goods may be stored in the warehouse and they are not collected, and the government may lose some revenue. So one condition to having goods in a bonded warehouse, the KRA may require a bond security, and you can see how the two work in tandem. And that is all for today's lesson on bonded warehouses and bond securities. We began by stating that in Kenya's customs system, bonded warehouses and bond securities are integral mechanisms that facilitate trade by allowing for temporary storage of imported goods before the payment of custom taxes and duties. So this provides businesses with the flexibility in managing their cash flow and logistics. So bonded warehouses are very essential facilities, particularly for importers. So thank you for attending the lesson. We will continue to share knowledge in customs taxes and excise taxes in our subsequent sessions. Bye. Hello candidates, and welcome to the Manifested e-learning platform. Today we continue with the subject Public Finance and Taxation. The chapter is Customs Taxes and Excise Taxes. The lesson is Customs Procedure in Kenya. Customs Procedure in Kenya is our today's lesson, and therefore by the end of this lesson you should be able to outline the Customs Procedure in Kenya, which is a structured process governed by the East African Community Customs Management Act. It is governed by East African Community Customs Management Act and administered by KRA through customs. It is first of all governed by East African Community Customs Management Act and administered by Kenya Revenue Authority through its Customs and Border Control Department. Border Control Department. It's important for you to understand that the customs procedure, there has to be a procedure, which is a process that aims to ensure that imported and exported goods comply with legal requirements, they comply with the applicable duties and taxes. The applicable duties and taxes are collected also, and trade is facilitated efficiently. The reason why we have this procedure is to ensure that trade is facilitated efficiently, is to ensure that the applicable duties and taxes are collected and that the imports and export comply with legal requirements. And candidates, this procedure is largely automated. The procedure is largely automated through the KENTRADE's National Electronic Single Window and KRA's Integrated Customs Management System. So in this lesson, we are going to highlight the procedure. The procedure. We'll highlight the procedure and the steps involved in this procedure, candidates. One is what we call pre-arrival information. Pre-arrival information. What do I mean by pre-arrival information? Now, before the arrival of goods, because we are talking about customs, before the arrival of goods in Kenya, the one who is importing the goods or their appointed clearing agents are required to submit what we call advance cargo information electronically through the KENTRADE's National Electronic Single Window. Pre-arrival information. Before the arrival of goods, the importer or the appointed clearing agent is required to submit advance cargo information electronically through the KENTRADE's National Electronic Single Window and through KRA's Integrated Customs Management System. You understand? And this includes details from the shipping manifest. Shipping manifest. Details from shipping manifest. The pre-arrival information includes details from shipping manifest. That is step number one. Step number two is to submit what we call import declaration. Submission of import declaration. Submission of import declaration. Here the importer or agent prepares and submits an electronic import declaration form and a customs entry document through the ICMS, which is the Integrated Customs Management System. And this declaration provides detailed information about the goods, detailed information about the goods. It has to contain detailed information about the goods, their value, their origin, and also and the classification of goods, and the applicable duties and taxes. And this submission has also to include supporting documents such as the commercial invoice, the bill of lading or airwell bill, the packing list, certificates of origin, the required permits or licenses from relevant government authorities like KEBS and so on. So that has to be done electronically. The documents are to be attached electronically. That is the second stage, submission of import declaration. First of all, there has to be the pre-arrival information that contains details from the shipping manifest. Then number two, the importer or the agent of the importer has to submit what we call import declaration, and that is done by filling the import declaration form and the customs entry document. And we've said this declaration provides detailed information about the goods, their value, their origin, the classification of the goods, and also the applicable duties and taxes. That is step number 2. The third stage in the customs procedure is verification and risk assessment. Now, the first 2 stages relate to the importer. It is the importer or the agent who provides this documentation. Then in the third stage, there is what we call verification and risk assessment. Now, upon submission, the declaration undergoes verification and risk assessment process with the Integrated Customs Management System. So the system and customs officers review the submitted information, including the supporting documents, in order to assess compliance and identify any potential risks. So the purpose for verification and risk assessment is so that the authorities can identify any potential risks associated with the import of the goods in the country. Then step number 4 is the assessment of duties and taxes. Assessment of duties and taxes. Assessment of duties and taxes. Now, based on the declared the customs value, based on the declared customs value in the second stage, and the classification of the goods and the prevailing East Africa Community External Tariff and National Tax legislation like VAT and Excise Duty Act, the Miscellaneous Fees and Levies Act, the system then calculates the applicable import duty, VAT, excise duty, import declaration fee, railway development levy, and other relevant levies. Based on information submitted, then the system can now assess the duties and taxes that the importer has to pay. And I've named some of the duties and taxes, like the VAT tax. We have the excise duty that has to be paid, the railway development levy, the import declaration fee, and so on. So the system then assesses the duties that ought to be paid. That is step number 4. Step number 4. Moving on to stage number 5, the fifth stage, step number 5 in the customs procedure in Kenya is payment of duties and taxes. Payment of duties and taxes. The importer or agent, upon assessment of duties and taxes, is in stage number 5 notified of the assessed amount of duties and taxes, and payment is typically made electronically through designated banks or mobile payment platforms integrated with the KRA systems, and proof of payment is crucial for the subsequent steps. So after assessing the amount of tax that the importer ought to pay, then the next obvious stage is to make the payment through the designated banks or mobile money payment platforms that are integrated within the KRA system, and there ought to be proof of payment which is necessary for the next stages, which number 6 is the documentary and physical verification. Documentary and physical verification. Documentary and physical verification. Now, after payment, the consignment may be subjected to documentary verification, and also based on risk assessment, physical inspection by KRA officials may take place. And this is to ensure that the actual goods match the declared information and that there are no prohibited or restricted items. So non-intrusive inspection technologies like scanners may be utilized at this stage of physical verification. So after payment, the consignment may be subjected to documentary verification and physical verification. The idea here is to ensure that actual goods match the declared information, because here, you recall, candidates, the importer was required to make the submission of documents regarding the import. It is the importer or agent who does that, but the government officials have to verify after the goods have now been received in the country. The customs officials will now carry out documentary and physical verification, because they will look at the documents that were submitted and the goods that were delivered to ensure that what was ordered was actually what has been received. And the reason for physical verification again is to ensure that the goods that are coming in are not the ones that are prohibited, and that will also be based on assessment of verification and risk assessment, because you recall in the third stage, the customs officials have to do verification and risk assessment, because we say that upon submission of the documents, the declaration undergoes verification and risk assessment process and the system where the system and custom officers review the submitted information to assess compliance and also to identify potential risks. Here, potential risks are identified. So that is also done in step number 6, verification. Then step number 7, seventh stage in the customs procedure in Kenya is release of goods. Release of goods. Once customs are satisfied with the compliance of the consignment and all duties and taxes have been paid, then the goods are released from customs control so that the importer can have access to the goods. And an electronic release order is generated through the system. The system generates an electronic release order. That is step number 7. Step number 8 is cargo release. Step number 8, port or cargo release. Now, the importer or agent then proceeds to the port or proceeds to the cargo terminal to complete the necessary procedures with the relevant port or terminal operators and then take possession of the goods. There are certain procedures that undergoes at the port or at the cargo terminal, and at that point where the importer then gets access to the goods, gets the possession of the goods. So that's the custom procedure for imports. This is customs procedure for imports. Imports. These are imports. If you're importing goods, then you have to undergo all these steps. But there is also a procedure for exports. Exports. Now, exports, first of all, candidates must be registered with the KRA. There has to be, the exporter has to be registered. So step number 1 is registration of exporter. Registration, exporter. For you to export goods, you have to do registration with Kenya Revenue Authority. Then the second step is submission of export declaration. Submission of export declaration. Now, similar to imports, an electronic export declaration form has to be filled and submitted through the integrated customs management system, providing details about the goods being exported, their value, their origin and destination, and supporting documents like commercial invoices, packing lists, and any required export permits or certificates have to be attached when submitting the export declaration form. That's step number 2. Step number 3 is verification and examination. Verification and examination. Now, customs may conduct documentary or physical verification of the goods to ensure that they match the declaration and they also comply with export regulations and any other restrictions or prohibitions. So step number 1 and 2, this is the role of the exporter. Then after the documents are submitted, they have to be verified by customs officials. Step number 3, verification and examination. The number 4 is staffing and scaling. Staffing and sealing. Staffing and sealing. Step number 4, staffing and sealing. Now, once verified, the goods are typically stuffed into containers, if applicable, under customs supervision, and the containers are sealed. You understand? Stuffing and sealing. Stuffing into containers ready for export, then sealing takes place under the supervision of the authorities. Then 5 is release for export. Export. Release for export. Now, upon satisfaction, customs grants a release for export and the goods are allowed to proceed to the point of exit. The goods are then allowed to proceed to the point of exit. It could be the port or cargo terminal. So that is, candidates, the procedure, customs procedure in Kenya. And this procedure, we started by saying that is governed by East African Community Customs Management Act and administered by Kenya Revenue Authority through its Customs and Border Control Department. We began by highlighting the steps in procedure for imports. One is pre-arrival information, where details from shipping manifests have to be included. Step number 2 is submission of import declaration. Step number 3, verification and risk assessment. Number 4 is assessment of duties and taxes. So the first step and the second step is the role of the importer. Then after these documentations are submitted electronically. It's important to note that all these things happen electronically. The importer has to go to the KRA portal and download forms, then fill the forms, then attach the necessary documentation like imports, commercial invoices, and if there are licenses that are required to be submitted, they are also submitted. Permits are attached to these forms. This is the role, step number 1 and 2 is the role of the importer. Then the submission of the documents is done. There is verification and risk assessment and assessment of duties and taxes. Now this is the role of the authorities. Verification and risk assessment. Then step number 4, assessment of duties and taxes. The authorities through the portal. The portal electronically generates or assesses the duties and taxes that are to be paid based on the information that is provided. So it generates it makes the assessment. You understand? The assessment of taxes, based on the declared customs value, because that is done in step number 2. Based on the declared customs value and the classification of the goods, and based on the prevailing East Africa Community external tariff and also the national tax legislation like VAT Act, we have the Excise Duty Act, the Miscellaneous Fees and Levies Act. Based on those acts and the national legislation and the East Africa Community tariffs, the system then calculates the applicable import duty, it calculates the applicable VAT, the excise duty, it calculates the import declaration fee, it calculates the railway development levy and other relevant levies in step number 4. In step number 5 is payment of duties and taxes. Once the system has identified or has made the calculation or has made the assessment, then the obvious step is to the importer to make the payment of duties and taxes in step number 5. The importer or the agent is notified of the assessed amount of duties and taxes. Then payment is typically made electronically through designated banks or mobile payment platforms integrated into the KRA system. Step number 5. Then number 6 is documentation and physical verification. Documentation and physical verification. After payment, the consignment may be subjected to documentary verification, and based on risk assessment, physical inspection by customs officers can also be done. Then number 4 is release of goods. Release of goods. Once customs are satisfied with the compliance of the consignment and all duties and taxes have been paid, the goods are released from customs control and an electronic release order is generated through the system. That is release of goods. Then finally, we have port or cargo release. Port or cargo release. The importer or agent then proceeds to the port or to the cargo terminal to complete the necessary procedures with the relevant port or terminal operators, and then they take possession of the goods. That is the procedure for imports. Then lastly, we have outlined the procedure for exports. First of all, the exporter has to register, what we are calling registration of exporter. Exporters must be registered with the KRA, step number 1. Number 2, they have to submit export declaration, just like the imports. They have to submit the export declaration, which comprises or has to include the nature of the goods, their value, the origin, the destination, and so on. And also supporting documents like commercial invoices must also be attached together with the certificates or even permits from the government where applicable. Step number 3 is verification and examination. Step number 4, staffing and sealing. Then release for exports. Release for export candidates. That is the customs procedure in Kenya, which comprises of the import. There is the import procedure and the export procedure. So thank you for attending this lesson. In the next session, we continue to share knowledge under the topic customs taxes and excise taxes. Bye-bye.
Welcome to Manifested e-learning platform. We continue with our series on tax planning, and today we are handling tax planning for body corporates. When you talk about tax planning for body corporates are limited company. What are the available opportunities that body corporates have for tax planning? Remember, we did say that tax planning is basically an arrangement of the taxpayers' affairs in such a way that they are able to reduce the tax payable to the Kenya Revenue Authority, and the word is without contravening the law. So some of the areas that are available for tax planning for a limited company, we say number one is what we call tax compliance. When you talk about tax compliance, we're basically saying that a company is able to file the taxes on due dates. And once such happens, we know that costs such as the interest penalties are able to be eliminated. We also have areas, for example, what we call financing. When it comes to financing a company, we say that a company can basically be financed using what we call a debt or what we call shares. But in terms of financing, we basically say that a company should be financed based on debt. Why that? We say that because interest that accrue from a debt in taxation is treated as allowable expense. On the other hand, if you're to pick shares, the cost of shares is what we call dividends, and dividends is what we call a non-allowable expense. We can also talk about areas of purchasing. You know, a company may have, for example, decision either to purchase an asset or to lease an asset. When it comes to purchasing, we say that a company should basically purchase instead of leasing. Why purchase? The ideal is that if a company purchases an asset, they're able to claim what we call investment stroke capital allowance on asset, which is an allowable expense. So we can say that the following are tax planning. The following are tax planning. We say tax planning opportunities. Tax planning opportunities that are available to a limited company, to a limited company, stroke body corporates. So we have our first one. We say that is tax compliance. We call it tax compliance. We have said that when you talk about tax compliance, is that when a company is able to be tax compliant, meaning filing taxes on due dates, on the right timing, we are able to eliminate the cost that accrue, like the interest, penalties, and etc. So we can say this reduces the cost related to what we call non-compliance. Reduces the cost related to non-compliance. Such as what we call fine, penalties, etc. And we can also, on etc, we know that some also interest. Then we have the second, we call it financing. When a company is basically financing its operation, a company may decide basically to finance either through debt or through shares. But we have said that when you decide to finance through debt, which is a debenture long-term loan, we know that interest that accrue from such debts is allowable deduction. But on the other hand, if we decide to finance using shares, the cost of shares, which is dividends, is not an allowable expense. And therefore, companies are always instructed to finance through debt, because interest that accrue from debts are allowable expense. So we say that to finance a company, a company can take a loan to finance. A company can basically take a loan or issue a debenture or issue a debenture or issue shares, basically for a company to finance. But we say this: the cost of loan stock debenture, and you know that the cost of loan stock debenture into bracket, that is what you call interest. The cost of loan into bracket interest is usually allowable expense, is usually what you call allowable expense, while the cost of shares, into bracket, that is dividends, into bracket dividends is a non-allowable expense, expense. So therefore, a company should finance its operation based on that. We have or the third opportunity that is available for companies to plan in terms of taxes. So that is making a decision whether to purchase a fixed asset or to lease. We have said that when we decide to purchase a fixed asset, the cost, we are able to claim what we call investment allowance or capital allowance, which is an allowable expense. On the other side, when you decide to lease, we do not have the option of getting what you call investment allowance. We can get only lease rental that may not be as much as the investment allowance. So say purchasing fixed asset, purchasing what you call a fixed asset instead of leasing. Purchasing fixed asset instead of leasing. This is because the cost of fixed asset will qualify for investment, stock what you call capital allowances. Will qualify for investment stock capital allowances, which reduces the taxable, income. And then you say while leasing, we know that the lease value does not qualify for investment. While leasing does not qualify for investment allowances. While leasing does not qualify for investment allowances. That is the third opportunity that is available for limited company in order to reduce or to plan for the taxes. We have the next that we call EPZ. Companies engage in export, that is the export processing zone. So companies that are basically engaged in EPZ, those are the export company. Some of the tax planning opportunities that are available for these companies, we know that they are usually granted a tax holiday for the first 10 years. But when it comes to the 11th year, we know that the tax is given at a minimal rate of 25%. So we can say for companies, we have number 4, for companies engaged engaged in export, for companies engaged in the export, we say that in export, located at the export, what we call export processing, located at the export processing zones, located at the export processing zone, have the following zone. These companies enjoy the following opportunities. Enjoys the following opportunities. We say enjoy the following opportunities. For those companies, we say that the granted tax holiday for the first 10 years, tax holiday for the first 10 years of operation, tax holiday for the first, we say for the first 10 years of operation, for the first 10 years of operation, they're granted a tax holiday. The second, to say that from the 11th year, they're normally taxed at a lower rate of 25%. They say tax rate of 25%. Tax rate of 25%, from the 11th year. Tax rate of 25% from the 11th year of their operation, of their operation, 11th year of the operation. But basically, we also say that, as an added, we know that all their purchases is zero rated. All their purchases is basically zero rated. So we can move to the next tax planning opportunity that is basically available to a limited company. We talk about investing in another company and acquiring more than 12.5% of the shares of that company. What is a tax planning opportunity? That is the question that raises in our mind. When a company basically invests in another company and owns 12.5% shares of that company or more. And in that case, we have companies being as, when you talk about associate, a relation as associate, joint ventures, and then we have what we call subsidiary. So if a company invests in another company where it controls 12.5% of those shares, the dividends that come from those companies are basically exempted from tax. Those dividends are basically exempted from tax. Investing, we say investing investing in another company, investing in another company, and acquiring 12.5% or more of the paying company. So when that happens, we know that those dividends that basically come from those companies is exempted from tax. So we say that in this case, dividends received. In this case, dividends received from the paying company, we say is exempted from tax. Is exempted from tax. The dividends that basically are received from that paying company, we say is exempted from tax. Is exempted from tax. Is basically exempted from tax. We have a number of tax planning opportunities still on this area. We can say that rather than waiting for refunds, you can decide that these refunds, rather than waiting for the refunds, we can basically decide that these refunds you don't wait for them, but they offset the tax payable that is in the future. Instead of waiting for the refund, which may take long, which may basically take long in order for a taxpayer to get, you can decide to use the refunds basically to offset the tax payable in the future, to offset the tax payable in the future. And we can also talk about applying for waivers, especially in where companies, where companies have tax penalties or tax in arrears that accrue a penalty. You can apply for waiver. And this, how do we do this? Especially when a country has provided amnesty programs or voluntary disclosure programs, you can take opportunity to apply for those waivers, and through that you're able to plan for the taxes. So we can say the next, that should be the 6th. That should be the 6th. We say that in case use of tax refund, use of tax refund to reduce tax payable, instead of waiting for the refund. Instead of waiting for the refund, you basically use the refund to offset tax that is payable in the future, instead of waiting for a refund, which may take a long process, which may take a long process. So one of the areas, for example, is our refund in relation to VAT, where we say that in order for you to be granted a refund, especially when a debtor has become bankrupt, you need what you call a letter from the liquidator, implying that indeed the debtor has become bankrupt, and that takes a longer process, to come up with invoice to show documentation that this and this happened. For that analysis to be done, you may decide to use the credits to offset the tax that is payable, and that is a way of planning. Applying for waiver. We can also talk about applying for waiver. What to call applying for waiver. Applying for waiver from the commissioner of domestic tax. From the Commissioner of Domestic Taxes. Applying for waivers from the Commissioner of Domestic Taxes. So we talked about applying for waivers from the Commissioner of Domestic Taxes. Is instead of waiting to pay the interest and penalties that basically had accrued on those accounts, you may decide to apply. For waivers from the Commissioner. Then we also talk about offshore business structure or tax haven. Offshore. We can talk about offshore business structure. So what we call the tax havens. So the tax haven. So tax haven is where taxes are not basically charged, or maybe low if they're there. Body corporate takes advantage. We say body corporates takes advantage. Body corporates takes advantage of tax difference, of what we call tax difference, of the tax difference. Body corporate take advantage of the tax difference. Stock what we call exemption. Exemptions. Body corporates, which are limited company, takes advantage of tax difference or the exemption, to in some jurisdiction, to reduce. We say to reduce the tax payable. To reduce what we call the tax payable, to reduce the tax payable or tax liability. Tax payable or liabilities. So that implies set the businesses in tax havens. Set the businesses in tax haven in order to have that. Then you have what you call thin capitalization. We know that when you talk about thin capitalization, basically we know that occurs where a company uses a bigger proportion of debt than equity in a capital structure, where a company or a body corporate uses a bigger proportion of capital to equity in capital structure. So we say occurs when a company uses a bigger proportion when a company uses a bigger proportion of debt than equity in the capital structure. Uses a bigger proportion of debt to equity in the capital structure. So we need to understand that the importance of this is that this reduces taxable income. This reduces what you call the taxable income. Since what you call interest on debt, which takes a bigger proportion, is allowable expense. Since interest on debt is allowable expense. Since interest on debt is basically an allowable expense. So we can also take advantage of double taxation relief. We know aspects of double taxation relief where a relief is granted when it comes to opportunities of an individual or a company being operating in one and the other. We have what we call double taxation relief. A company can take advantage of that. And I want to say that basically these are some of the opportunities that are available to a limited company in relation to tax planning.
Greetings and welcome back, candidates, to the lesson. The subject is public finance and taxation. The topic is public debt management. Today we are going to discuss the objectives of debt management in public sector. So by the end of this lesson, we should be able to explain the objectives of debt management in public sector. And effective debt management is a critical component of a sound fiscal management and macroeconomic stability. Public debt management is critical, and governments in managing their debt pursue several key objectives aimed at ensuring financial sustainability and supporting broader economic goals. So these objectives are often interconnected and require a delicate balance in order to achieve them. It is like a skill. It requires those who are managing the finances of the government to have this skill in order to ensure what we call sustainable financial and broader economic goals. So what are these objectives of debt management in the public sector? That's what we intend to achieve or to do in our today's lesson. Now, the first objective of debt management in public sector is to ensure that the government's financing needs and its payment obligations are met at the lowest possible cost over the medium to long term, consistent with a prudent degree of risk, to ensure the government's financing needs and its payment obligations are met. Ensure financing needs and payment is to ensure the government's financing needs and its payment obligations are met. Obligations are met. And the financing needs or these obligations or the loans should be at the lowest possible cost over the medium term to the long run, consistent with the prudent degree of risk. And this is often cited as the main objective. It emphasizes obtaining the necessary funding for the government operations and the government investments while minimizing the burden of debt servicing on the budget, but without taking on excessive risks that could jeopardize financial stability. So the primary objective is to ensure that government's financing needs and the government's payment obligations are met at the lowest possible cost over the medium to the long run. That is point number one. The second objective is to manage risks inherent in the government's debt portfolio. To manage risks. We know that there are those risks that are inherent in the government's debt portfolio. To manage risks inherent in government's debt portfolio. To manage risks inherent in government's debt portfolio. Now, public debt portfolio is exposed to various risks, including interest rate risks, which is a change in interest rates affecting debt servicing costs. We may have the currency risk. The currency risk is the risk of fluctuations in exchange rates affecting the cost of foreign currency denominated debt, and also the refinancing risk, which is the risk of not being able to borrow to repay maturing debt. You understand? So the objective of managing debt in the public sector is to manage these risks. Do you understand? And effective debt management seeks to identify, to measure, and also to mitigate these risks through appropriate debt structures and instruments. That is the second objective. The third objective of debt management in public sector is to promote a development of an efficient government securities market. To promote the development, it is to promote the development of an efficiency, to promote the development of securities market. To promote the development of an efficient securities market. An efficient securities market. An efficient government securities market. Because a well-functioning domestic debt market can promote a stable and reliable source of financing for the government, which then reduces reliance on external borrowing and then contributes to the development of the broader financial sector. And debt managers play a role in issuing a range of securities, promoting market liquidity, and also fostering a diverse investor base. So the third objective of the debt management in public sector is to promote the development of an efficient government securities market. That is point number 3. Objective number 4 is to ensure debt sustainability. To ensure sustainability. To ensure debt sustainability. This involves managing the level of debt and also the composition of debt in a way that the government can meet its current and future debt obligations without compromising its ability to finance essential public services or requiring disruptive fiscal adjustments. And this objective has become increasingly important in the context of rising global levels of debt. To ensure debt sustainability. 5, candidates, we are discussing the objectives of debt management in the public sector. The 5th goal is to ensure the sharing of the benefits and costs of public debt between current and future generations. To ensure the sharing, of benefits and costs of debt between the current and future generations. To ensure the sharing of benefits and costs of debt between the current generation and future generation. Because debt incurred today will need to be serviced and repaid by future taxpayers. And therefore, debt management decisions should consider the long-term implications and aim for a fair distribution of the burden across generations. The current generation should not take debts that will be a burden to future generations. No, there should be that sharing of the benefits and also the cost of debt between the current generation and the future generation. That is the 5th objective of debt management in the public sector. The 6th point or objective is to support the government's fiscal and monetary policies. Monetary policies. To support the government's fiscal and monetary policies. So the debt management operations can have an impact on liquidity in the financial system and also interest rates. And therefore, there is need for coordination with the monetary policy. So debt management operations can have impact on liquidity in the financial system and interest rates, and therefore need to be coordinated with the monetary policy. Similarly, debt management is closely linked to fiscal policy because it deals with financing budget deficits and managing the overall level of government debt. So these are 6 core objectives of debt management in the public sector. The first objective is to ensure financing needs and payments and government's payment objections are met. And they ought to be met at the lowest possible cost over the medium to long run, consistent with the prudent degree of risk. The second objective is to manage risks that are inherent in government debt portfolios. 3 is to promote the development of an efficient government securities market. Number 4 is to ensure debt sustainability. 5 is to ensure the sharing of the benefits and costs of debt between the current and future generations. Number 6 is to support government's fiscal and monetary policies. So these are 6 objectives, and achieving these objectives requires a clear legal and institutional framework. It requires a well-articulated debt management strategy. It also requires strong analytical capacity to assess costs and risks and to effectively coordinate. It also requires effective coordination among the relevant government institutions, including the Ministry of Finance, the Central Bank of Kenya, and all that. So thank you for attending the lesson on objectives of debt management in the public sector. I'll meet you in our next session where we continue to share knowledge under the topic public debt management. If you have any questions, we allow questions. Below this video, there is a comment section where you can post your questions and all your questions will be answered. Bye. Greetings and welcome to the Manifested e-learning platform. The subject is Advanced Public Financial Management. We are on the 8th topic, which is the Office of Auditor General. This topic has 6 subtopics, namely 1, the establishment of the Office of Auditor General and overview of the Public Audit Act. Number 2, the appointment, roles and function of the Office of Auditor General. 3, responsibilities of the Auditor General, relationship between the internal audit function and Office of Auditor General. 4, challenges facing auditing public sector institutions. 5, the role of Parliament as oversight body and parliamentary oversight committees in the National Assembly and the Senate. Number 6, which is the last subtopic, challenges affecting the Parliament as oversight body. Today we begin with the first subtopic, which is the establishment of the Office of the Auditor General and overview of the Public Audit Office. These are 2 things: establishment of Office of Auditor General and overview of the Public Audit Act. We begin with establishment of Office of Auditor General. The Office of the Auditor General in Kenya is a cornerstone of the country's public finance accountability framework, which is established with a broad mandate to audit and report on the use of public resources. And this independent office functions and powers are primarily enshrined in the Constitution of Kenya 2010 and elaborated upon in the Public Audit Act. So the Office of the Auditor General is established as an independent office. It is established as an independent office. It's important, first of all, to note that it is an independent office. It is established as an independent office under Article 229 of the Constitution. It is established as an independent office under Article 299 of the Constitution of Kenya. And this constitutional anchoring provides the office with the necessary independence to perform its functions without direction or control from any other person or authority, which is a crucial element for effective public sector auditing. So the establishment of the Office of the Auditor General is a significant feature of Kenya's governance structure, which aims at promoting transparency, accountability, and good stewardship of public funds. And historically, the function of public sector auditing existed in various forms before being consolidated and granted enhanced independence under the 2010 Constitution of Kenya and subsequent legislation. Now let's briefly highlight the mandate. The mandate and functions of this office. Now, Article 229 of the Constitution outlines the core mandate of the auditor, the Office of the Auditor General, which is to audit and report in respect of each financial year on the accounts of, number one, the national and county governments. That's the first. Number two, all funds and authorities of the national and county governments. Number three, all courts. This office is required to audit all the financial statements of all the courts. Number four, every commission and independent office established by the Constitution. Number five is the National Assembly, the Senate, and the county assemblies. We also have political parties that are funded from public funds. Number seven, we have the public debt. Number eight, any other entity that legislation requires the Auditor General to audit. And furthermore, the Constitution requires the Auditor General to confirm whether or not public money has been applied lawfully in an effective way. So that's the mandate and function of the Auditor General. Article 229, I repeat, outlines the core mandate, which is to audit and report in respect of each financial year the accounts of the national and county governments, all funds and authorities, every commission and independent office, all the courts, the National Assembly, the Senate, and the county assemblies, political parties funded from public debt, the public debt, and any other entity that legislation requires the Auditor General to audit. So the Auditor General is also required to confirm whether public money has been applied lawfully. And that goes beyond just financial legality to include an assessment of economy, efficiency, and effectiveness in the use of public resources. So the audit reports are then submitted to Parliament and to the relevant county assemblies, which then use the reports to exercise their oversight role over the executive and other public entities. So that is the mandate and function of the Office of the Auditor General as enshrined in the Constitution. So that is we've looked at the establishment. It is established as an independent office under Article 229. We have outlined the functions. Let's move on to overview of public audit debt. Overview of public audit debt. But let me, for the sake of remembering, let's put down the functions. We've said that the Office of the Auditor General is required to audit and report the accounts of one, national and county governments. The second set is all funds and authorities. All funds and authorities of the national government and county government. All funds. Then we have three. This is all funds and authorities of national government and county government. Now, number three, accounts of all the courts, all the courts. Then we have 4, every commission. The Auditor General is also required to audit the accounts of every commission and independent office that is established under the Constitution. Moving on to the 5th is the National Assembly. National Assembly, the accounts of National Assembly, the accounts of the Senate. National Assembly and the accounts of the Senate. 6, public debt. The Auditor General is required to audit and report on the national debt. We also have political parties funded by public funds. The political parties that are funded by the public funds are also required to be audited, and any other entity. So let's move on to overview of Public Audit Act. Public Audit Act. Public Audit Act. Public Audit Act. The Public Audit Act of 2015 was enacted to operationalize Article 229 of the Constitution. It was enacted to operationalize Article 229 of the Constitution. It was enacted to operationalize Article 229 of the Constitution, because the Constitution was promulgated in 2010. It was promulgated in 2010. Then in 2015, the Public Audit Act was enacted to operationalize Article 229 of that Constitution. All right? And provide a comprehensive legal framework for the functions and the powers of the Auditor General and the operations of the Office of the Auditor General. And we have key provisions of this Act, which includes the functions and powers of Auditor General. Provisions include 1, powers and functions of the Auditor General. That is one aspect. The powers and functions of the Auditor General. Now, the Act details the specific functions and powers of the Auditor General, including the authority to assess all necessary books, records, and information from audited entities, and to require persons to appear before the Auditor General to give evidence. Number 2, scope of audit. That's another provision of the Public Audit Act. The Act reinforces and elaborates the constitutional mandate, specifying the entities subject to audit. It also clarifies that the audit extends to confirming whether public money has been applied lawfully and in an effective way, encompassing aspects of economy, efficiency, and effectiveness, which is value for money audit. Understand? Then types of audits. Types of audit. Types of audits. The Act provides for different types of audits conducted by the Office of the Auditor General, including financial audit. This includes a financial audit. This is the audit of the financial statements. All right, expressing an opinion on whether financial statements are presented fairly in accordance with applicable financial reporting framework. We may also have compliance audit. Compliance audit. Compliance audits assesses whether activities and financial transactions of an entity comply with relevant laws, regulations, and policies. Performance audit. Then we also have performance audit, which examines the economy, efficiency, and effectiveness of public sector programs, projects, and operations. Could also have special audits. The Office of the General Office of the Auditor General may also perform special audits, which are undertaken at the Auditor General's discretion or upon request to investigate specific issues such as allegations of fraud, waste, or even mismanagement. Now, the fourth provision of this Act is reporting, audit reporting. Audit reporting. Candidates, we are discussing just an overview of the Public Audit Act, and these are some of the provisions. Number 4, audit reporting. The Act sets out the requirements of audit reports, including their content, format, and also the timelines for their submission. It mandates the Auditor General to submit audit reports to Parliament or even relevant county assemblies within 6 months after the end of the financial year. 5, follow up on recommendations. Follow up on recommendation. The Act emphasizes the importance of following on audit recommendations made by Parliament and county assemblies to ensure that audited entities take appropriate corrective action. The 6th provision is on independence of the Office of the Auditor General. Independence of the Office of the Auditor General. The Act includes provisions aimed at safeguarding the independence of the Auditor General and also the Office of the Auditor General, including matters related to the appointment, tenure, and removal of the Auditor General, as well as the financial autonomy of the office. 7, public access to information. Public access to information. Public access to reports or information. The Act requires the Auditor General to publicize audit reports after their submission to Parliament or the relevant county assembly, which promotes transparency and allowing a public scrutiny of how public resources are utilized. So this is an overview of the Public Audit Act. The overview of the Public Audit Act. We've said that this Act was enacted to operationalize Article 229 of the Constitution. Before then, we had discussed how the Office of the Auditor General is established. We've said that the Office of the Auditor General is an independent office under Article 229 of the Constitution. We've clearly outlined the mandate and functions of the Office of the Auditor General. We've said that the Auditor General is required to audit and report on accounts of national and county governments, all funds and authorities of national government and county governments, all the courts, every commission and independent office that is created under the Constitution, the National Assembly and Senate, public debt, political parties, and so on. Then we've given an overview of the Public Audit Act. Overview of the Public Audit Act. We've laid out the provisions of this act in relation to 1, powers and functions of the Auditor General. Number 2, scope of audit. Number 3, types of audit, which include financial audit, compliance audit, performance audit, special audits. Then number 4 here we have audit reporting. 5, follow up on recommendations. Then we have independence of the Office of the Auditor General and public access to information. And therefore, candidates, in summary, we can say that the establishment of the Office of the Auditor General under the Constitution and the comprehensive provisions of the Public Audit Act provides a strong legal foundation for independent external oversight of public finances in Kenya. And the work of the Office of the Auditor General is vital. It is important for promoting accountability, for improving public sector performance, and also enhancing public trust in government institutions. Thank you for attending this lesson. In our next session, we continue to share more knowledge and information on the Office of the Auditor General. This was just but the first lesson under the topic, the Office of the Auditor General. The subject is Advanced Public Financial Management. Bye. Hello, candidates, and welcome to the Manifested e-learning platform. Today, we are going to do a comparative analysis of the State Corporations Act and the Companies Act in Kenya. The subject is Advanced Public Financial Management. We are on topic number 5, Public Sector Investment and Enterprise Management. So the lesson is a comparative analysis of the State Corporation Act and the Companies Act in Kenya. And here in Kenya, the landscape of corporate entities is primarily governed by 2 key pieces of legislation. That is the State Corporations Act, Chapter 446, and the Companies Act of 2015. And while the Companies Act provides the foundational legal framework for the incorporation and operation of all companies, the State Corporations Act specifically addresses entities that are owned or controlled by the government. So understanding the interplay and the distinctions between these 2 acts is important for comprehending the legal and regulatory environment for both private and public entities in Kenya. Now, as we do a comparative analysis, our analysis of our comparative analysis will be on the basis of 4 things. 1 is the purpose and establishment. Number 2, we will do a comparative analysis on governance and oversight. Number 3, we can analyze the regulatory framework and compliance. Then lastly, the application and overlap of the 2 pieces of legislation. So the first basis of our comparative analysis is purpose and establishment. Purpose and establishment. Purpose and establishment. Now let's first of all consider the State Corporations Act. The State Corporations Act. Now, the Act is specifically designed to provide a legal framework for the establishment, the control, and regulation of state corporations. And these entities are typically created to perform specific functions of strategic, commercial, or service delivery nature on behalf of the government, often with a public interest mandate. So state corporations can be established by a presidential order, can be established by a specific act of parliament, or just by being registered under the Companies Act with the government holding controlling interest. How about the Companies Act? The Companies Act provides a comprehensive legal framework for the incorporation, registration, operation, and winding up of various types of companies, including private limited companies, public limited companies, and companies limited by guarantee. And its primary purpose, the primary purpose of the Companies Act is to facilitate business and commercial activities by providing a legal structure for enterprises focusing on aspects like shareholder rights, corporate governance, commercial viability, and so on. So we've analyzed the purpose of state corporations, the establishment of state corporations and companies, and also the Companies Act. Let's move on to the second basis for comparative analysis, which is governance and oversight. Governance and oversight. Governance and oversight. Now, state corporations are subject to significant government oversight. State corporations are subject to significant government oversight, and the Act provides for ministerial responsibility, allowing the relevant cabinet secretary to give policy directions. It also establishes oversight bodies like the Inspectorate of State Corporations and the State Corporations Advisory Committee, which play roles in monitoring performance, advising the president on establishment and dissolution, and also ensuring adherence to government guidelines. So the composition of the board of state corporations is often influenced by government appointments. So we are analyzing these two acts on the basis of governance and oversight. Now, on the part of the Companies Act or companies registered under the Companies Act are primarily governed by their memorandum and articles of association, now simply just known as the Companies Constitution under the 2015 Act. And it is also governed by the provisions of the Act. That is governance. Companies that are formed under the Companies Act are governed by the company's constitutions, specific constitutions. Do you understand? And oversight, because we have governance and oversight. How about oversight of companies that are formed under the Companies Act? Now, oversight is primarily exercised by the shareholders, the board of directors, and regulatory bodies relevant to their specific industries, like the Capital Markets Authority for publicly listed companies, and so on. So the focus of governance under the Companies Act is largely on protecting shareholder interests and ensuring compliance with corporate law. Corporate law. 3, let's analyze companies formed under the Corporations Act and Companies Act on the basis of regulatory framework and compliance. Regulatory framework and compliance. regulatory framework, and compliance. State corporations are subject to a dual layer of regulation. They must comply with the provisions of the State Corporations Act, including directives from the Inspectorate of State Corporations, as well as the Public Finance Management Act, due to their handling of public funds. Due to their handling of public funds, they have to comply with the provisions of the Public Finance Management Act. They are also subject to audit by the Auditor General. On the other hand, companies governed solely by the Companies Act must comply with its requirements regarding incorporation, share capital, filing of returns, conduct of meetings, and winding up. So public companies are subject to more stringent regulations and disclosure requirements compared to private companies. And compliance is primarily monitored by the Registrar of Companies and other regulatory bodies. So that's how the state corporations and companies formed under Companies Act can be analyzed. Regulatory framework. Regulatory framework. Lastly, we have application and overlap. Application and overlap. Now, the State Corporations Act applies specifically to entities defined as state corporations, regardless of whether they are established by a specific act or registered under the Companies Act with government control. You understand? The State Corporations Act, I repeat, applies specifically to entities defined as state corporations, regardless of whether they are established by a specific act or registered under the Companies Act with government control. On the other hand, the Companies Act applies to all incorporated companies under it. However, when a company is majority owned or controlled by the government, it falls under the definition of state corporation. So if a company is formed under the Companies Act, but such company is wholly controlled by the government, then it's defined as a state corporation. And therefore, the provisions of the State Corporations Act will apply to such a company, even though it is formed under the Companies Act. And it becomes subject to the provisions of the State Corporations Act as well. And that creates an area of overlap where a single entity must comply with the requirements of both acts. That's the overlap we are talking about. So the overlap occurs when government entities are registered as companies under the Companies Act, and while they are legally companies, their government ownership brings them under the purview of state corporations, under the purview of state corporations, under the purview of the State Corporations Act. And that can sometimes lead to complexities and potential conflicts, particularly regarding board appointments, management autonomy, financial regulations, and even reporting requirements. Because the governance principles and objectives of the two acts may not always be fully aligned. So the State Corporations Act often imposes stricter controls on greater degree of ministerial direction compared to the general corporation governance principles under the Companies Act, which are geared towards private enterprises and shareholder value. And in Kenya, recent legislative discussions, and we've had proposed reforms such as the potential introduction of specific legal framework for government-owned entities under the Companies Act, which aim to address some of the overlaps and provide clearer guidance or governance structures for commercially oriented entities where the government has conflicting interests. So that is the comparative analysis of the State Corporations Act and the Companies Act in Kenya. And it's important to note that while the Companies Act provides the general framework for companies in Kenya, the State Corporations Act introduces what we may call a specialized regime for government-controlled entities, reflecting their unique nature, their public mandate, and also the need for enhanced public sector oversight and accountability. So the interaction between these two acts, particularly in the case of government-owned companies, highlights the complexities and the governing hybrid entities within the Kenya's legal system. So that's all for today's lesson. Thank you. We'll meet our next session where we continue to cover the topic public sector investment and enterprise management. Bye-bye. Hello, everyone, and welcome to the Manifested e-learning platform. We continue with the sharing of knowledge in advanced financial management. The topic is advanced financing decision. We, in today's lesson, going to begin on a new subtopic, which is long-term financing decisions. Long-term financing decisions. The syllabus requires us to look at 3 areas. That is bond refinancing decision, which is a long-term financing decision. We have the lease buy evaluation and rights issues. So we'll be taking one at a time. In today's lesson, our focus will be on bond refinancing decision, which is a key financial strategy for companies that have issued bonds, and it involves replacing existing bonds with new ones. So in this lesson, we will be analyzing the factors in bond refinancing. We'll also answer the question, why refinance bonds? Then at the close of the lesson, we are going to work out a KASNEB Advanced Financial Management past paper question that was tested in December 2024. So candidates, welcome to the lesson. Those are our lesson objectives. By the end of this lesson, you should be able to explain the meaning of bond refinancing, you should be able to outline the factors considered in bond refinancing decision and also reasons why companies refinance bonds. Then you should be able to work out any computational question associated with bond refinancing. So first of all, we define what is bond refinancing. So bond refinancing is the process of issuing new bonds to pay off existing bonds. If a company issued new bonds 5 years ago, it may choose to refinance by issuing new bonds. And the primary goal is usually to reduce the company's interest expenses, because companies that issue bonds are required to pay interest on the bonds. And this is often done when interest rates have fallen since the original bonds were issued. And there are various factors in bond refinancing. So let's highlight some of the factors. Factors in bond refinancing. Factors. So get it clearly first, candidates, that Bond refinancing involves replacing existing bonds with new bonds. That's the definition. So what are some of the factors in bond refinancing? The first key factor is interest rates. Interest rates. This is the most significant factor, because if current interest rates are lower, the current interest rates are lower, today's interest rates, if they are lower than the coupon rate on the existing bonds, then refinancing can lead to substantial savings. That is a significant factor. The second factor is call provisions. Call provisions. Many bonds have what we call call provisions. These are provisions that allow the issuer to redeem the bonds before maturity. However, before redeeming such bonds, the company may need to consider if there are any what we call premiums or penalties that are associated with such provisions. Call provisions. 3, transaction costs. There are costs that are associated with refinancing bonds. Issuing new bonds involve costs such as underwriting fees, such as legal fees, and other expenses. And such costs must be weighed against the potential interest payments, such that if the potential interest payments exceed the costs associated with bond refinancing, then the company can go ahead and do bond refinancing. The fourth factor is time to maturity. It's a factor to consider. Time to maturity is a factor in bond refinancing. Time to maturity, the remaining time of maturity of the existing bonds, time to maturity of the existing bonds, the remaining time, and also the time or the maturity of the new bonds may influence the refinancing decision. Time to maturity. 5, company credit rating. The credit rating of the company that is issuing the bonds, because an improved credit rating can allow a company to issue new bonds at a lower interest rate. Then finally, market conditions. Market conditions. This is yet another factor in bond refinancing. Market conditions. The overall market volatility, including the investor appetite for bonds, also play a larger role in the ease and the cost of refinancing. So these are factors in bond refinancing. 6 factors. Number 1, interest rates. Number 2, call provisions. Number 3, transaction costs. Number 4, time to maturity. Number 5, company credit ratings. And 6, market conditions. The next question we need to answer in this lesson is why bond refinancing? We need to answer the question why. Why issue new bonds to pay off existing bonds? That's the question we want to answer. Why bond refinance? Why? The first reason is related to the first factor here, which is interest rates. The first reason, key reason, is to reduce interest rates. To reduce interest rates. To reduce interest rates. This is the common driver of bond refinancing. The common driver. The common reason. This is what drives bond refinancing. When market interest rates fall below when market interest rates fall below the coupon rate of the company's existing bonds, then refinancing allows the company to issue new bonds at a lower interest rates, thereby reducing interest payments. And that can translate to significant interest cost savings over the life of the bond to reduce interest rates. 2, to extend maturity. To extend maturity. Refinancing can be used to push back the maturity date of debt, to push it back. And that provides the company with more time to repay the debt, which may improve its cash flow and its financial flexibility. And that is especially beneficial if the company anticipates future cash flow challenges. Extending maturity. We're moving on to the third reason why companies bond refinance is to change bond covenants. To change bond covenants or agreements. That's another reason. Bond covenants are agreements between the bond issuer and the bond holders that restrict certain actions by the issuer. So refinancing offers an opportunity to renegotiate these covenants, potentially improving the restrictive clauses or adding more favorable clauses. To change bond covenants, there are certain agreements that the two parties agree, and mostly these are restrictive clauses that hinder the bond issuer to carry out certain actions. So during refinancing, these covenants can be altered. Now, the fourth reason is to improve financial flexibility. To improve financial flexibility. Bond financing is carried out to reduce to improve financial flexibility. Because by reducing the debt service costs, by reducing the interest payments and extending maturities, because we say that is one of the reasons to reduce interest rates, to extend maturity. By doing so, that allows the company to pursue other strategic initiatives. That allows the company to increase its financial flexibility. The money that is saved can be used to do other things. The company can pursue other strategic initiatives such as investments, such as acquisitions, mergers, and so on, to improve financial flexibility. Company can only engage in such strategic actions if it has financial flexibility. So doing financing can allow the company to be more flexible to engage in other activities. We can go on and mention the fifth reason, which is to capitalize on improved credit ratings. To capitalize on improved credit ratings. Now, at the time of issuing the original bonds, the credit ratings of the company may be low. But over time of, say, 5 years, these credit ratings may increase. So if a company's credit ratings has improved since it issued its original bonds, it can refinance at a lower interest rate. Because a higher credit rating signifies lower risk to lenders, allowing the company to secure more favorable terms. So these are 6 reasons why companies issue new bonds to pay off existing bonds. 1, to reduce interest rates. 2, to extend maturities. 3, to change bond covenants. 4, to improve financial flexibility. 5, to capitalize on improved credit ratings. So we covered 2 aspects of our today's lesson. We had 3 objectives. The first objective was to define bond refinancing and outline the factors in bond refinancings and to give reasons why companies do bond refinancing. The third part of this lesson was to work out computation question that was tested by KASNEB, and in this lesson we are going to answer the question that was done or tested in the sitting December 2024 sitting. December 2024 sitting. We are going to answer December 2024 question 4C. Allow me to first rub the board. December 2024 question 4C reads as follows. ABA Limited has a 20-year 14% debenture worth 250 million Kenya shillings, which has been in operation for the last 10 years. ABA Limited still has its book issue cost amounting to 900,000 shillings, being half the total amount originally capitalized. The debenture can be paid off anytime, but the financials will charge a penalty amounting to 9% of face value. The directors of the company are considering replacing this debenture with a new 10-year 12% debenture with a face value of 250 million Kenya shillings. The issue cost will amount to 10% of gross proceeds. The company is in the 30% tax bracket, and there will be interest overlap for 3 months required. Roman 1, the net cash investment that will be issued or required to replace the existing debenture. Roman 2, the annual cash benefits to be derived from financing the current debenture. Roman 3, using the NPV method, advise ABA Limited on whether or not to refund the existing debenture. That's the question. And you can see from this question, candidates, ABA issued a 20-year 14% debenture worth 250 million. You see the interest rate is 14% and the new one is 12%. The new 10-year, this one was 20 years, this is 10 year. Do you see that? Yes. So the interest rate has gone down from 14% to 12%. So we are required here to candidates to calculate the net cash investment that will be required, the initial cash investment that is required to replace the existing bond. And we read that the issue cost will amount to 10% of gross proceeds. We also read that the company is in that bracket. We also read that the debenture can be paid off at any time, but the financial will charge a penalty amounting to 9%. So there is that penalty of 9% of face value, which is one of the costs, because we have to calculate the initial investment cost. So the first here cost is the penalty, the call penalty of 9%, and it is 9% of the face value. What is the face value? The face value is 250 million. So that's the first element of the investment amount. Then apart from that, we read that the company is in the 30% tax bracket and there will be interest overlap for 3 months. That interest overlap is also part of the net cash investment. That interest overlap is part of the net cash investment, and it is 14% of 250 million Then we prorate it at 3 months. That will be 3/12. Do you have any other course? Yes. We read something to do with the issue course. Issue course, we had issue course. Look at the second sentence. ABA Limited still has in its books issue cost of 900,000. There is that issue cost of 900,000, which is half of the total amount originally capitalized, which is half of the total amount originally capitalized. Then we read the second last sentence there, that the issue cost will amount to 10% of gross proceeds. So the issue cost here will be 10% of the gross proceeds. What is the gross proceeds? The gross proceeds is the face value of the bond, which is 250 million. So those three aspects, those three elements will constitute the net cash investment. That will constitute the net cash investment, the three elements. So here is the answer to part Roman 1. Roman 1, we are to calculate the net cash investment. Net cash investment. Very straightforward candidate, this one. In fact, we begin with the issue costs. Issue costs. So we have issue costs, and since the issue cost here is 10% times 250 million, amounting to, this is just 25 million. 25 million. Then there is a call penalty. Call penalty. The call penalty, reading from which sentence? Let me identify the sentence. The call penalty was 9%. The debenture can be paid off at any time, but the financiers will charge a penalty amounting to 10% of the face value. 10% of the face value. So 9%. This is 9% of the face value, which is 250 million. Do you see that? Yes, 9% of 250 million is 22,500. The next element is overlapping interest. Overlapping interest. Now, overlapping interest, first of all, the rate is, the coupon rate there for the old bond is 14%. It is 14% of the 250 million times, we prorate 3 months. That is 3 months, is it not? 3 months. 3 months. That is overlapping interest. 14%, 3 months. Okay. The company face value, the issue cost, the penalty, the interest 14%. Overlapping interest is that. So we get the amount there. 8,750,000. These three will give us the net cash investment. 25 million plus 22,500,000 plus 8750. It's total of 56,250,000. That is the net cash investment. That is the gross initial cash outlay. Then we have to deduct some expenses. We have to deduct expenses or deductions. What are the deductions? Look at the question again. We have the call penalty, which will lead ABE to enjoy some benefit tax benefit. There are tax benefits associated with the call penalty because this is the gross initial cash outlay. This one is the gross initial cash outlay. That is the gross, it's not the net. We have to calculate the net. Net means we get the gross initial outlay, then we deduct any benefits. So these ones are costs. We are going to deduct tax benefits less tax benefits. Tax benefits. The first obvious one is on the call penalty. Call penalty. Call penalty. The company will enjoy 30% of the call of 22,500. The overlapping interest, there is a benefit associated with overlapping interest. Again, 30%. Overlapping interest, 87.50. Now look at the question again. We have the issue costs. Reading from the question, the second sentence we read, ABA Limited still has in its book issue costs amounting to 900,000. Okay, that 900,000, that is an amortized issue cost, which will also, the company will enjoy a tax benefit on that. So we have an amortized issue cost, an amortized issue cost of 30% times 900,000. So I'll take my machine and get the amounts. 67.50. Then we have 26.25. It's 900. It's 270. All these are benefits, so we deduct from the initial cash outlay. So the total benefits is 46,605,000. This is the net cash investment. Net cash investment. So that is Roman number 1, net cash investment. Net cash investment. So that's the answer, the net cash investment. To Roman number 1. Roman number 2, the annual cash benefits to be derived from refinancing the current debenture. Look at the question again. The annual cash benefits to be derived from refinancing the current debenture. Now, how do we calculate the annual cash savings? We get the difference between the new cash flow of the old bond and the new cash flow from the new bond. The cash flow from the old bond and the cash flow from the new bond. That's how to calculate or determine, that's the formula for determining the annual cost savings. Annual cost savings. Annual cost savings. Roman 2, annual cost savings. How do you calculate the annual cost savings? You get the difference between the net cash flow of old bond and the net cash flow of new bond. This is equal to net cash flow of old bond minus net cash flow of new bond. To have a saving, then what the cash flows that are obtained from the new bond should be lower than the cash flow obtained from the old bond. So we are going to calculate to determine the two, then we compare, and that will give us the answer. So we have workings. Remember I told you formula is very important. Put down the formula, then work out. So this is the formula. To calculate the annual cost savings, we'll get the net cash flow of old bond. Deduct net cash flow of new bond. You just need two things. So let's work out, first of all, the net cash flow of old bond. Working one, net cash flow of the old bond. The cash flow, net cash flow of the old bond. Now, what will the cash flow constitute? We're going to have the cost, then we deduct any benefits. The cost, we deduct benefits. And the first cost associated with the old bond is the overlapping interest. The overlapping interest. So first of all, we have the overlapping interest. We know the interest is 14%, and it's 14% of 250 million. 14% times 250 million. How much is it? Take my machine. That will be 14% times 250. This is 35, is it 35 million? We have 3 zeros up there. 35 million. That's the first element. The cost. That's the only cost that we have. Then we will deduct any benefits, tax benefits. So the first tax benefit, we have the interest, the tax shield benefit. Tax interest, let me just call it interest tax shield. Interest tax shield. The interest tax, let me call it interest tax shield. And this is just 30% of this interest of 35 million. 30% of 35 million. I just multiply by 30%. That will be 10,500,000. We deduct. This is a benefit. We are deducting, it is reducing the cost. Then we check for any item that reduces the cost, which is the amortized issue cost. The amortized issue cost. We had earlier on calculated the unamortized. Now the amortized issue cost, look at the question. The amortized issue cost is how much? The amortized issue cost. Do you have any percentage? We have any percentage? Look at the question again. Yes, look at the second last sentence. Says the issue cost will amount to 10% of gross proceeds. Then in note number 2, we read that ABA has still in its books issue cost amounting to 900,000 shillings, being half the total amount originally capitalized. This debenture can be paid off at any time, but the financials will charge a penalty of 9%. So what is the amortized issue cost? What is the amortized issue cost? We have that information. The issue cost will amount to 10% of gross proceeds. Now we read from the second sentence, ABA Limited still has in its books issue costs amounting to 900,000 shillings, being half the total amount. So that is the amortized issue cost, 900,000. So the tax benefit will be 30% of 900,000. Amortized issue cost, the benefit 30%, 900,000. This is equal to 270. Is it 270 or 27? 270 or 27? It's 27. Calculator. It's 27. 270,000. 270,000 is a benefit. We deduct it from the interest. So how much is it? It's 24,230. 24,230. So these are, it's just 270 here because you have 3 zeros up there. 24,230. That is the net cash flow of all bond. The net cash flow of all bond is 24,230. Then we calculate the net cash flow of the new bond. The net cash flow of the new bond, I'll go to page 3 here, my page 3. This is the net cash flow of old bond, working 2, net cash flow of new bond. Now to calculate the net cash flow of new bond, look at the question. We have the interest of the new bond. First of all, we have the interest. The interest rate is 12% times 250 million. I have my 3 zeros here. Then we are going to deduct the tax shield benefit. The interest tax shield benefit is 30% of the interest. How much is it? This is 12%. 12% times 250 million. 30 million. 30% of 30 million. 30% of 30 million is just 9 million. It's 9 million. Is a deduction. Then we deduct any other shield benefit. Amortized issue cost. We have amortized issue cost. Now the amortized issue cost, from the question we read, look at the question. The issue cost will amount to 10% of gross proceeds. 10% of gross proceeds. So we have 30% of 10% of gross proceeds, 250 million times. So 30% times 10% times 250 million. 250 million times 10%, that will be 25 million. 25 million times 30%. 7.5 million. 7.5 million. There are 3 zeros up there. So we get the net. The net will be 30 million. 30 million minus 9 million minus 7.5 million. This gives me 13.5 million. 13.5 million is the net cash flow of the new bond. The net cash flow of the new bond is 13,500,000. So the difference will be the annual cost savings. The annual cost savings, you get the difference. 10,730,000. 10,730,000 is the annual cost savings. Is the annual cost savings, and that is Roman 2. Roman 3, we moved Roman 3 using the NPV method. Advise ABA Limited on whether or not to refund the existing debenture, on whether to fund the existing debenture. So we are going to get the NPV, and we know the NPV is equal to the present value of cash flows of cash inflows minus present value of cash outflows. That is the NPV. So Roman 3 we have to calculate the NPV. We know NPV is equal to present value of cash inflows minus present value of cash outflows. We have the cash outflow here. This is the cash outflow. So we have the cash outflow. What we not have is the present value of the cash inflow. So the cash outflow, we have it 46, this one 46 605 605,000. What we need to calculate is the present value cash inflow, the present value cash inflow. So we will have a working for the present value cash inflow. Look at the question. Look at the question. Look at the question. We are going to get the present value of cash inflow. The present value of cash inflow. So we're going to discount this saving. We discount this saving to get the present value of cash inflow. And what is the discounting rate? What will be the discounting rate? What will be our discounting rate? What will be our discounting rate? Let's look at the question. Do we have any clue on the discounting rate? Any clue on the discounting rate? Any clue on the discounting rate? Look at the question. Do we have the discounting rate? The discounting rate, do we have it? We have 14%. Then we have 9% there. That is the penalty. We have the 12%. That is the new face value. Which discounting rate do we use? Which discounting rate do we use? Which discounting rate do we use? Now, we're going to use the after-tax cost of new debt. After-tax cost of new debt. The after-tax cost of new debt. Now, the after-tax cost of new debt, after-tax of new debt or new debenture will be equal to the 12, it is 12%. After tax will be, we multiply 1 minus 0.3. This will give us the discounting rate. So that is 12%. 12% times 0.7. And this is 8.4% will be our discounting rate. So to determine the present value of cash inflows, the present value of cash inflows, this inflow, this saving, we multiply this saving of this present value of cash inflow will be equal to the 10,730 times the present value of 8.4%. How many years do we have? These are how many years? The 10 years. 10 years. So given that the discounting rate is a decimal, this cannot be read directly from the tables, and therefore you are going to use the formula. You are going to apply the formula. You are going to apply the formula. So this is 10,730 times the formula is 1 minus 1 over 1 plus r raised to n over r. That is the formula we use, this factor. It can't be read directly from the tables, and therefore this will be equal to 10,730 times 1 minus 1 over 1.084 raised to 10 over 0.084. So when you multiply this annuity with this factor, what do we get? So you go to the machine and punch in these inputs. These inputs will give us 70,708,211. So this is the present value interest factor. 70,718,211. That is the present value of cash inflow, which we need here. This is 70,718,211. That's the present value cash inflow. We deduct the present value cash outflow to get the NPV. 70,718,211 minus 46,605,000. Is that right? Yes. So I get here 24,113,211. That is the NPV. The question is, using NPV. Let's go back to the question. Using NPV, go back to the question. Using NPV method, advise ABA on whether or not to refund the existing bond. And given candidates that the NPV is positive, then ABA should refund the existing debenture. Advice. ABA should refund the existing debenture. Why? Since the NPV value is positive. The NPV value is positive because the NPV value is positive. So that's it for that question that was tested in December 2024. December 2024, we have done part 1, we have done part 2, we've done part 3. Part 1, candidates were to calculate the net cash investment. The net cash investment, and these are the entries. So the net cash investment is 46,605,000. We've gone ahead, calculate the annual cost saving. How do you calculate the annual cost saving? We get the difference between the net cash flow of old bond and the net cash flow of new bond. These are the entries. And we have the workings for the net cash flow of old bond. These are workings for old bond. And here are the workings of the net cash flow of the new bond. 1, 2, 3. Then in Roman 3, you have to calculate the NPV based on NPV to advise on whether to refinance the bond. And we've seen that the NPV is positive. Given that the NPV is positive, then the company ABA can refund the existing debenture because the NPV is positive. Thank you for attending the lesson. We continue to share knowledge in our next session. Make sure to attend. God bless you. Bye-bye. I greet you all and welcome you to the Manifested e-learning platform. In today's lesson, under the topic Role of Accounting Officer in Management of Public Funds, we are going to study the financing and operationalization of public funds in Kenya. These are two things: financing and operationalization of public funds. Now, the public funds in Kenya, established by, as we saw earlier on, the Constitution and the relevant legislation like the Public Finance Management Act, are the lifeblood of government operations. Their financing and operationalization are governed by strict rules and procedures aimed at ensuring accountability, transparency, and the prudent use of public resources. So let's begin with the financing of public funds, which I've said these two, financing and operationalization, are the lifeblood of government operation. The government cannot deliver services without finances. So the financing of public funds in Kenya is derived from various sources which are collected and channeled into the appropriate funds as mandated by law. And this source could be tax revenue. One source of public funds is tax revenue. Revenue from taxes. This is the primary source of government revenue. Taxes collected by the Kenya Revenue Authority and other designated bodies such as the income tax, the value added tax, the customs duties, and the excise duty are paid into the consolidated fund at the they are paid into the consolidated fund at the national level. So we have tax revenues. Then we have non-tax revenues. Tax revenues are given examples: VAT, customs, excise, income tax, and all that. Number two, we have non-tax revenues. These include fees, charges, fines, licenses, and revenues from government services and investments. And these revenues are also channeled into relevant public fund, primarily the consolidated fund for national governments and the county revenue fund for county governments from sources like rates, single business permits, cessation of services. Those are paid into the county revenue fund. Non-tax revenues. 3, grants. Both national and county governments receive grants from development partners like the bilateral and multilateral partners and other level of government. So these grants, whether program support or for specific projects, are paid into the relevant national or county public fund unless specifically excluded by legislation for a dedicated fund. Another source of financing is borrowing. The national government can borrow from domestic and international sources to finance its budgetary requirements, and the proceeds from government borrowing are paid into the consolidated fund. County governments also have limited borrowing powers subject to approval and guarantees, and the proceeds are channeled into their respective county revenue fund. Borrowing. Both governments have powers to borrow. 5, other receipts. Apart from tax revenues, non-tax revenues, grants, and finances from borrowing, there are also other receipts. And this includes proceeds from the sale of government assets, dividends from state corporations, and other miscellaneous receipts which are paid into the appropriate public fund. And for the county revenue fund, the main sources of financing are the equitable revenue share or equitable share of revenue raised nationally, which is transferred from the consolidated fund based on the Division of Revenue Act and the County Allocation of Revenue Act and their own sources revenue. We may have specific purpose funds that are established by legislation for particular objectives, like what we saw earlier, the equalization fund, the contingency fund, and various specific sector-specific funds, which receive their financing as specified in legislation establishing the funds. And that will be through appropriations from the consolidated fund, dedicated revenue streams, or even contributions from specific sources. Other receipts. Now let's briefly discuss operationalization of public funds. Operationalization of public funds. Operationalization of public funds. Now, the operationalization of public funds involves the management, the control, and the disbursement of the money held within the funds. And the process is strictly governed by the Public Finance Management Act, and it involves various actors. It involves various actors. All right? And that would include receiving and accounting for revenue. Receiving and accounting for revenue. Receiving and accounting for revenue. First of all, I've said that operationalization of public funds involves the management, the control, and the disbursement of money that is held within the funds. And that may involve receiving and accounting for revenue. Designated receivers of revenue are responsible for collecting public money and ensuring it is promptly paid into the correct public fund bank accounts primarily held at the Central Bank of Kenya. And therefore, there ought to be proper accounting records that must be maintained for all revenue collected. So operationalization of public funds may involve receiving and accounting for money. Now, operationalization may also include the management of funds. Management of funds. Management of funds. Management of funds. And management of funds may be carried out by the National Treasury. The National Treasury, that is one actor. The National Treasury is responsible for overall management of national government public funds, including the Consolidated Fund, Equalization Fund, and Contingencies Fund. And that involves maintaining the accounts, managing cash flow, and also ensuring the security of the funds. Two, we have county treasuries. The county treasuries. Each county treasury is responsible for the management of its county revenue fund and any other county public funds. And that includes receiving and accounting for county revenues and managing the fund's bank accounts. So that is management of funds at the national level and the county level. Operationalization may also involve, number 3, withdrawal and expenditure. Withdrawal and expenditure. Withdrawal and expenditure. Money can only be withdrawn from public funds with proper legal authorization. First of all, there has to be constitutional and legal authority to withdraw. Constitutional and legal authority. Constitutional and legal authority to withdraw. Withdrawals from the Consolidated Fund candidates require an appropriation by an act of Parliament. Require the Appropriation Act. There could also be constitutional provisions, like for urgent expenditure or pending the passing of the Appropriation Act, or even as a charge against the fund authorized by the Constitution or legislation. Similarly, withdrawals from the County Revenue Fund require authorization through a County Appropriation Act. Another layer of control here is the role of the controller of budget. Role of controller of budget. Now, the controller of budget plays a key oversight role, because no money can be withdrawn from the consolidated fund or even the county revenue fund unless the controller of budget has approved the withdrawal. And the controller of budget's withdrawal or approval is based on being satisfied that the withdrawal is authorized by law and in accordance with the approved budget. Then, still under withdrawal and expenditures, we have what we call issue of warrants. Issue of warrants. Based on the approved budget and the controller of budget's authorization, the National Treasury issues warrants to national government entities, and county treasuries also issue warrants to county departments, allowing them to incur expenditure up to authorized amounts. So the National Treasury has to issue warrants to national government entities. The county treasury has also to issue warrants to county departments, authorizing them to spend the money up to the authorized amounts. So, candidates, just to take you back, operationalization, we say, means or involves the management, the control, and disbursement of the money held. So after the money may be received, the money has to be managed, there has to be withdrawals and expenditure. Then number 4, there is the aspect of accounting and reporting. Accounting and reporting. Government entities that receive funds from the public funds are required to maintain proper accounting records of their expenditures and report on their financial performance regularly. And then the National Treasury prepares consolidated financial statements for the national government's funds, and the county treasuries do the same for the county public funds. And these reports are subject to audit by the Auditor General. And that leads us to the 5th point, which is audit and oversight. Audit and oversight. Now, the Auditor General audits the accounts of all public funds and entities that utilize public money to ensure that resources have been applied lawfully and effectively. And the audit reports are submitted to Parliament and the relevant county assemblies, which exercise oversight over the executive's management of public funds. So these are the processes under operationalization of public funds. 1, receiving and accounting for revenue. 2, management of funds. 3, withdrawals and expenditure. For withdrawal to happen, there has to be constitutional and legal authority. The controller of budget has to approve the withdrawal. Then there has to be issue of warrants by the National Treasury for the national government. The county treasury also issues warrants for the county departments to spend money up to a certain limit. Number 4, accounting and reporting. And lastly, audit and oversight by the Auditor General and The Auditor General, after auditing the reports, the audit reports are sent to Parliament for oversight. So the financing of public funds candidates, you can see, involves the systematic collection and channeling of various revenue streams into legally established accounts. These are the streams of revenue: tax revenues, non-tax revenues. The tax revenues, we said, include the taxes from customs duties, excise duties. We have value-added tax, income tax, corporation tax, and many other taxes. Then another stream is a non-tax revenues. The government also raises money through non-tax means, and this could include fees, charges, fines, licenses, and also revenues from government services and investments. And these revenues are also channeled into the relevant public fund, primarily the Consolidated Fund for National Government Entities and the County Revenue Fund for county government. For county government, we have rates. They get money from single business permits, cessation of services, and so on. Another stream is grants, borrowing, which could be domestic borrowing or foreign money from foreign sources. Then we have other receipts. So you can see the financing of public finance involves, there is that systematic collection and channeling of various revenue streams into legally established accounts like the Consolidated Fund. While operationalization entails the control and authorized withdrawal and utilization of funds for public purposes, subject to rigorous accounting, reporting, and audit processes to ensure accountability and transparency. That effectively brings this lesson to an end. The lesson was financing and operationalization of public funds. Bye. Hello, candidates, and welcome to the manifested e-learning platform. The subject is Advanced Public Financial Management. We are proceeding with the topic, the Office of the Auditor General. Today, we're going to discuss the appointment process of the Auditor General in Kenya. In our next session, we'll be covering the functions and responsibilities of the Auditor General. So the functions that appear in subtopic 2, we are going to cover in subtopic 3. Today, our focus will be on the appointment process of the Auditor General, who is crucial. The Auditor General of Kenya, as an individual, represents the office of the Auditor General, which is an independent office that is established by the Constitution to ensure accountability in the use of public funds. So the appointment process for this vital role is clearly outlined in the Constitution of Kenya 2010 and further elaborated in the Independent Offices Appointment Act of 2011. So the process is designed to be transparent and involves both the executive and the legislature, which emphasizes the independence of the office. In this lesson, we discuss some of the key steps in this process of appointing the Auditor General. And the first step is what we call declaration of vacancy. declaration of vacancy. Now, when a vacancy arises in the office of the Auditor General, which may be due to death or expiry of term or resignation or removal from office, the President is required within a period of 7 days of the vacancy occurring to declare the vacancy by notice in the Gazette and in at least 2 newspapers of national circulation and 2 national radio and television stations. The President has to declare that that office is vacant. That's the first step. Number 2 is application and nomination. Application and nomination. Interested and qualified individuals are invited to apply in step number 2. Those who are interested are invited to do what? To apply, and applications are forwarded to the Public Service Commission, which is responsible for conducting the initial screening and shortlisting of candidates. And the Independent Officers Appointment Act outlines the qualifications required for the position, in addition to those specified in the Constitution, which is the extensive knowledge of public finance or at least 10 years experience in auditing or public finance management. So then the Public Service Commission selects at least 3 qualified candidates or for the position. So individuals are invited. The Public Service Commission selects out of those who have applied 3 positions. Then we move to the 3rd stage. After applications and nominations, we have the selection and submission to the President. Selection and submission to the President. Selection and submission to the President. The Public Service Commission, within a specified time frame, which is 7 days of the selection, forwards the names of the shortlisted candidates to the President. Within 7 days, after identifying the 3 candidates, the Public Service Commission then submits the names within 7 days to the President. The 4th step is presidential nomination. Presidential nomination. The President, within 7 days of receiving the names from the Public Service Commission, nominates one candidate from the list and forwards their name to the National Assembly for approval. The names are then forwarded to the National Assembly by the President for approval. Then obviously, step number 5 is parliamentary approval. Parliamentary approval. After the names are submitted to Parliament by the President, the National Assembly considers the nomination. This typically involves vetting of the nominee by a relevant parliamentary committee, usually the Department Committee on Finance, Planning and Trade, followed by a debate and a vote by the full House. So the National Assembly may either approve or reject the nomination. The National Assembly, after the President submits the name to the National Assembly, the National Assembly has 2 options: to reject or to approve the nominee. After which we move to the 6th stage, which is the appointment by the President. If the Parliament approves the nominee, then we have appointment by the President. Appointment by the President. If the National Assembly approves the nomination. The Speaker of the National Assembly informs the President of the decision. The President then formally appoints the Auditor General by notice in the Gazette within 7 days of receiving the National Assembly's approval. After the gazettement, then the Auditor General in point number 7 is sworn in. Swearing in. Swearing in then takes place. The appointed Auditor General is required to take and subscribe to the oath or affirmation of office before the Chief Justice. Before the Chief Justice. Do you understand? Before assuming office, the appointed Auditor General has to be sworn in by the Chief Justice. Be sworn in by the Chief Justice before assuming office. And that is the process, candidates. The Auditor General, upon being sworn in, the Auditor General, upon being sworn in, serves for a single term of 8 years and is not eligible for reappointment. Is not eligible for reappointment after the period of 8 years. So this provision, along with the constitutionally protected independence of the office and the robust appointment process involving both the executive and the legislature, is intended to enable the Auditor General to discharge their mandate without fear, without favor, thereby strengthening public financial accountability in Kenya. And we also know, candidates, that the removal of the Auditor General from office is also subject to a rigorous process outlined in Article 251 of the Constitution, requiring grounds such as gross misconduct, grounds such as violation of the Constitution, or inability to perform the functions of the office. And it involves a tribunal and a potential referral to the National Assembly. So these are the steps involved in the appointment of the Auditor General. The Auditor General. Number 1 is declaration of vacancy. Number 2, application and nomination. Step number 3, selection and submission to the President. Number 4, presidential nomination. 5, parliamentary approval. 6, appointment by the President. And lastly, swearing in. That's it for today. Thank you for attending the lesson. Bye-bye. Greetings, candidates. I'm back to continue with the subject Advanced Financial Management. In today's session, our focus is on International KPM and Behavioral KPM. These are two things: International KPM and Behavioral KPM. Now, International KPM is a capital asset pricing model in a global context, whereas Behavioral KPM is an extension of the traditional KPM that attempts to incorporate the effects of psychological biases on asset pricing. So it's important for us to have that understanding as we get into the dynamics of International KPM and Behavioral KPM. So candidates, when considering the capital asset pricing model in a globalized context, in a globalized financial world, it's important or essential to understand the adaptations that have been made to address its limitations. Understand? International KPM, I repeat, is just the normal capital asset pricing model, but in a globalized financial world. So we're going to look at the various aspects of international campaign. The first aspect is it addresses global investments. It addresses global investment. International campaign addresses global investment. International campaign, number one, it addresses global investments. It addresses global investments because the traditional campaign is primarily designed for domestic markets. The normal campaign is designed for domestic markets. But the international campaign extends this model to account for complexities of international investments. It recognizes that investors often hold diversified portfolios that include assets from various countries. So that's the first aspect. International campaign. It addresses global investments. The second aspect is currency risk. Currency risk. Currency risk. Now, a key difference is, we are talking about a key difference between the international campaign and the domestic campaign. A key difference is the incorporation of currency risk. So fluctuations in exchange rates can significantly impact the return of international investments. So international campaign then attempts to quantify and factor in this currency risk, providing a more accurate assessment of the required returns. 3, market segmentation. Market segmentation is a key aspect of international campaign. Market segmentation. International campaign addresses the issue of market segmentation. Unlike the traditional campaign, which assumes a perfectly integrated market, international campaign assumes perfectly integrated markets. But international campaign acknowledges that markets may be segmented due to factors like regulatory barriers, factors like information asymmetry, political risks, and so on. Lastly, increased complexity. This is another aspect of international campaign as compared to the domestic campaign. There is increased complexities. The international campaign is inherently more complex than the traditional campaign due to the additional factors involved. So estimating currency risk and accounting for market segmentation can be challenging. So that's all for now we can say about international campaign. These 4 aspects helps you acknowledge the difference between the domestic or the traditional campaign with the international campaign. Let's move on to behavioral campaign. Behavioral campaign. As I said earlier, behavioral campaign is an extension of the traditional campaign that attempts to incorporate the effects of psychological biases in asset pricing. Essentially, it recognizes that investors don't always behave rationally. It also recognizes that investors may make irrational decisions. These are decisions that are based on emotion, decisions that are based on feelings, as opposed to decisions that are logical. So irrational behaviors we know can also influence market outcomes. Behavioral KPM. Now, in analyzing behavioral KPM, we have to acknowledge that behavioral KPM challenges rationality. Challenges rationality, as I said earlier. The traditional KPM assumes that investors are rational and they make decisions based on expected utility. However, behavioral finance recognizes that investors are often influenced by psychological biases, and therefore behavioral KPM incorporates these behaviors and factors into the asset pricing models, these irrational behaviors, behavioral biases. We are talking about behavioral biases. You understand? This version of KPM attempts to include the effects of biases, such as overconfidence is one of the biases. Overconfidence. Investors often overestimate their abilities and the accuracy of their information, and that can lead to excessive trading and also belief that they can beat the market. So in a KPM context, overconfidence can cause investors to underestimate risk and sometimes even overestimate expected returns, leading to mispricing of assets. Another example is hoarding mentality. Hoarding mentality or hoarding behavior. Investors may follow the crowd even when their own analysis suggests a different course of action, and that can create what we call bubbles. It can create crashes in asset prices as investors collectively buy or sell assets based on sentiment rather than fundamentals. So in a KPM context, hoarding can lead to collective investor behavior. So that's another example of behavioral biases. Loss aversion. Example number 3, loss aversion. Investors tend to feel the pain of losses more than the pleasure of gains. More strongly than the pleasure of gains. And that can lead to risk-averse behavior when facing potential losses and risk-seeking investors or behavior when trying to recover losses. And therefore, candidates in a KPM context, loss aversion can cause investors to hold on to losing investments for too long and sell winning investments too quickly, and that may affect asset prices and returns. So these are just 3 examples of biases that can cause market inefficiencies that deviate from the predictions of the traditional KPM. Understand? So we are analyzing behavioral KPM candidates, and we've said that it challenges rationality. There's also the aspect of behavioral biases. We have mentioned 3 here. There are more. These are not the only ones. These are examples. I know we will delve deeply in these biases when studying behavioral finance. 3, impact. Number 3, impact on asset pricing. Behavioral CAPM seeks to explain anomalies that traditional CAPM cannot, such as excess volatility, such as predictable patterns in asset returns, and so on. Then lastly, the other aspect of behavioral finance is related to psychological factors. Psychological factors. Behavioral CAPM attempts to add a layer of what we call psychological realism to the calculations of expected returns. So this helps us candidates understand the key differences. The key differences, just to sum it up, between the behavioral finance and the traditional finance is that the key differences, first of all, between the international CAPM and the behavioral CAPM is that the international CAPM expands the scope of CAPM to include international factors, primarily the currency risk and market segmentation. But when it comes to behavioral CAPM, the behavioral CAPM challenges the fundamental assumptions of investor rationality, and it incorporates psychological biases into asset pricing. Do you get the point, candidates, of the international CAPM vis-a-vis the traditional CAPM? And we have the behavioral CAPM, which challenges the fundamental assumptions of investor rationality. So that's all for today, candidates. In this lesson, we've studied the international CAPM and the behavioral CAPM. Thank you for attending the lesson. Bye-bye.
We proceed with question 5B, that is December 2024, block revision question 5B. We read the question. In a tax seminar, one of the facilitators noted generally there are two main types of tax system that are adopted by different countries. That is unified and unified tax system and multiple tax system. With reference to the above statement, argue 3 cases against multiple tax system adopted by your country. Argue 3 cases against multiple tax system adopted by your country. So the first thing is to understand what we mean by unified tax system and what we called a multiple tax system. We say that unified tax system is where we have one form of tax that we use. For example, we can pay corporation tax as the only tax that we basically levy. But when you talk about multiple taxes, this is where a system where we basically have what we call variety of taxes. We have the corporation taxes, we have the excess duty, we have the capital gain, and many other taxes. So for this particular question, the examiner basically asks us that with the reference above, based on the above information that we're given, what are cases against multiple tax system adopted by different countries? Cases against multiple taxes, that means disadvantages. That is what we call disadvantages of what we call multiple tax system. One of the dangers of multiple taxes is that it becomes very complicated, for taxpayers to understand. Again, administering these taxes we know is very costly. Administering the taxes is very costly. in terms of administration of those taxes, because you need to employ various officers in order to minister those taxes. Number 2 or 3, we need to understand that there's also what you call double taxation. You know, you could find that some taxes overlap where you charge the same tax more than once. That is what you call double taxation. We know that one of the things is non-compliance, because you know it's a nuisance. You know, when you have a variety of taxes, even it becomes a nuisance to the taxpayers. And one of the things that basically will emanate from double taxation or from multiple taxes, there will be a series of non-compliance, because this becomes what you call a nuisance to the taxpayers. But we can also talk about what you call adverse result, where we have canon of economy productivity affected by multiplicity. You know, the canon of economy, that you know the cost of collecting tax not being higher than tax collected. If you have multiple taxes, you can find again adverse effect in that you can have the cost of collecting taxes being more than the taxes collected. We can also pick one of the canons when you talk about productivity. You know, sometimes you find that you may put a lot in terms of enforcement and in terms of collection in these taxes, and then therefore not the taxes not being productive enough. So we can put them down and say double taxation. One of the disadvantages, we call it double. We say double taxation. Double taxation, a potential of taxing taxpayers more than once. We say potentially it can lead to, potentially it can lead to what you call double taxation. Double taxation. Potentially it can lead to double taxation. Potentially it can lead to double taxation, whereby the same tax, whereby we say that the same tax is the same income tax. Income tax is taxed in multiple jurisdiction. Jurisdiction is being taxed in multiple jurisdiction. So 2, we talk about costly. You know, the cost of implementing becomes. We say that costly may lead to higher. This may lead to higher. We say may lead to what you call higher. May lead to what you call higher. May lead to higher tax. To a higher. To higher tax. Compliance. May lead to what you call higher tax compliance. Compliance in terms of administration. In terms of what you call administration. Administration costs. In terms of what you call administration cost. And professional costs. And what you call professional. What you call the professional costs. And the professional cost. That is the second. Then we have what you call adverse results. Adverse results. Adverse results. We have what you call the adverse results. Adverse results, they may go against the canon of taxation. You know, we have the canon of economy where we say that a good tax should be cost effective. A good tax system should basically be cost effective. We were saying that, you know, when you talk about being cost effective, the cost of collecting taxes should not be more than the tax collected. But when you have multiple taxes, we can have it, you know, the cost of collection being more than the tax that is collected. So that is saying the canon of economy. The canon of economy. We say that the canon of economy. Productivity. Canon of economy, productivity, and convenience, may may be adversely affected, may be adversely affected as a result of what you call multiplicity of taxes, charging variety of taxes. So that may be affected as a result of charging what you call variety of the taxes. Then we talk about what you call inefficiency. Inefficiency. We have what you call inefficiency. That comes from the word of inefficient. So when you talk about inefficiency, it can cause what you call grave inefficiency in terms of collection by the tax authority. It may cause inefficiency in terms of collection by authority, where when there is multiplicity, there is a aspect of the tax authority ganging those officers with the taxpayers, and those are the inefficiencies that are likely to be there. The tax system, let us say the tax system may cause grave inefficiencies, may cause what you call grave inefficiencies, may cause grave inefficiency in terms of collection, in terms of collection, what you call collection by what you call the tax authority, in terms of collection by the tax authority. Then you can have the last one as 5. As we wrap up on that particular question, we talk about non-compliance. What you call non-compliance. Taxpayers not being compliant. And why would taxpayers be non-compliant? When you have a variety of taxes, it basically become nuisance for the taxpayers in terms of even understanding. You find majorities of the taxpayers are basically in positions where they see the taxes, but they do not even understand, because there are a lot of taxes, and therefore leading to most of them not paying those taxes, and that is what you call non-compliance as the last disadvantages or cases against the non-cases against double tax, cases against multiple taxes. That is on cases against multiple taxes.
Hello learner, welcome to Manifested e-learning platform. My name is Emily Ngwiri. Today we are discussing Business and Data Analytics, December 2024. The question of focus is question 23. Let's read together. Elimu Bazaar Foundation runs a group of secondary schools in the country. Among their schools is Masomo Bora High School. The schools are funded by school fees and partially sponsored by capitation from the government and donations from alumni and well-wishers. Masomo Bora High School is preparing the budget for the year 2025 with 3 terms commencing January, May, and September. The following details relate to the budget preparation. Number 1, the school estimates it will have 120 students in Form 1, 110 students in Form 2, and 100 students in Form 3, and 100 students in Form 4. The Form 1s will report in February 2025. The following is the fee structure that is payable by the parents per term. Form 1, 33,500. Form 2, 36,500. Form 3, 43,500. Form 4, 45,000. Number 2. Parents are usually required to pay 60% of the fee when the school opens. The balance at the beginning of the next month. Form 1s pay 60%, when they report in February and 40% in March. Number 3, the school receives a capitation of 16,000 per student per term, which is received at the beginning of the term. Number 4, on average, the school receives donations of 2.5 million per month, but this reduces to 60% when the school is closed. Number 5, the school has a small farm from which it generates harvest produce. It is estimated that the produce generates 200,000 per month. Number 6, in addition, the school hires out the bus every weekend for events earning 60,000 per month, except in December when the bus driver is on leave. Number 7, the school pays on average salaries and wages of 6.2 million per month, even when the students have closed. Number 8, the school spends on average 550,000 on general consumables, which reduce to 60% when the school is closed. Number 9, the school buys new textbooks and also replaces old ones at the beginning of every term for 650,000. Number 10, the school provides meals to staff and students at an average cost of 1.5 million per month. This is catered for in the school fees and capitation. The amount reduces to 40% when the school is closed. Number 11, electricity and water bills average 150,000 per month and 50,000 when the school is closed. Repairs and maintenance also amount to 250,000 per month and reduces to 40,000 when the school is closed. Number 12, the school plans to buy additional also for the whole year. Also for the whole year. So what we're going to do, ladies and gentlemen, we are going to move towards the right here as usual, and then we are going to now bring forth or break down in form of an analysis per month what we'll be talking about, what Form 1, the number of students, and also the fees that are going to be paid per student. Let's dive right in. So here we have January like that. And we are saying we are preparing for which year? For this as a 31st December 2025. So we will begin by January. So just come over here and say Jan hyphen 25. And then February hyphen 25. Not like that. We're just going to say, we're going to put Jan 25. That. Then you're going to put Feb 25. Feb 25. That. So when you have Jan 25, so it's not following through like that. So we come over, what we do, just come like this.